Banks are very smart. RBI always is chasing bank. Bank is always one step ahead of RBI. Once repo rate is increased, bank increase the lending rates. Ideally, deposit rate should also increase. Lending rate should also increase. But they do not increase the deposit rate. They increase the lending rate. So all these agencies have one to comply with the regulatory norms of RBI, and also supervisory norms flows from NABARD. DHFL loans, India Bulls, LIC Housing Finance, PNB Housing Finance, any financing company, any NBFCs whose portfolio has more than 50%, I guess 50 or 60% portfolio into housing financing is considered as housing financing companies. So money and banking, obviously we'll talk about the monetary policy and also the banking system. Inflation tomorrow. Inflation, poverty, unemployment. This is a sequence in any technically. So money and banking will be covering today. Technically we should have covered capital market also, but it is very difficult because this itself is huge. So tomorrow, a day after tomorrow, with taxation we will be covering that capital market. Since taxation would be covered in some of these, would be covered in budget also. Majority of the highlights of taxation would be covered in the budget also. So we have two ways of covering taxation. So capital market I have shifted it to with taxation. Okay. Okay. So money and banking. So the basic premise of this class would be majority of the questions turn up from this particular segment. So you are required to have an aware mind and need to know about certain factual data also, one thing factual also, and also need to have comparative analysis and a logic. You need to develop certain logic. You need to eliminate some of these things. Whenever the question comes up, it is very difficult to know all the details, all the fine prints, the RBI directives or any of the directives. It's very difficult. You're not preparing for any like RBI grade B or any public sector bank examination. Technically, had you been preparing that examination, you would have covered these things in details, but that is not the case in case of UPSC. So you need to use your intelligent guess. We'll be seeing those things where we can apply certain logics also. Okay. So obviously in this section, we'll be also covering some of the terms also, like spreads, policy corridors, stances, all these things, because what happens, somehow they can come out with a statement. It may not be a standalone question, but they can come out with a statement and you are required to know about the concepts first. I'll say, so the money as a function, it has medium of exchange, measure of value, store of value, and standard of deferred payment. Medium of exchange means the two transacting parties should be able to transact without the need to go for direct goods exchange, because that creates an issue that is known as double coincidence of wants. That is very difficult to satisfy. So that is why money acts like an intermediary. Okay. So it is intermediary eliminating double coincidence of wants. It is clear? What is this? Then measure of value. What is the meaning of measure of value?
Rent, wage, interest, anything that is.
Exactly. What happens whenever we say GDP is value, final value of all goods and services produced in an economy. But that values are always written, we have seen that, in lakh crore. So we are actually measuring that value. It is a measurable thing. So we in an economy are not creating money, we are creating values. Values are getting exchanged. You are buying services, you are buying goods, you are actually exchanging values. But how those values could be segmented and measured, this is measure of value. And from there we have created certain units or currency units. Certain currency units, and that property itself is known as fungibility. What is this fungibility? Have you heard this thing? Fungibility?
Can be
divided into. Like, for example, to reach that value, standardized metrics can be added, subtracted, multiplied to reach that particular value. Just like weights.
So can you differentiate between fungibility and non-fungibility, sir?
Exactly what. If fungibility means every units, if we need to create 100 rupees value, we can reach by adding 1 rupee till 100 times, or we can reach 20 rupees into 5 times, or 50 rupees into 2, or 100 rupees into 1. The value would be identical since one unit of that currency has same value. These are broken items and every unit has identical values. That itself is both those, even 1 rupee coin into 100 or 50 rupee note into 2 adds up to the same values and both are identical. So basically 100 rupees can be broken into those individual units and all these individual units are identical. But there is one more thing, that is non-fungible token. So fungibility, cryptocurrency is a fungible token. But NFTs are non-fungible token, because in cryptocurrency you would have seen that nobody is anyone owning 1 Bitcoin at least. I don't expect anyone owning 1 Bitcoin. But many of you may be owning 0.00005 Bitcoin.
So how can we say it's fungible, sir, cryptocurrency?
That is what I am saying. See what happens, that 1 Bitcoin can be broken into a particular value which can be affordable. Like owning 0.0005, because 1 Bitcoin is technically around what 60-70 lakh rupees. It is very difficult to own that thing. So technically had that been non-fungible, either you own 1 Bitcoin or you do not own any Bitcoin. But since it is fungible, so even the smaller units are equal in values. And that can add up to that 1 Bitcoin or whatsoever you have. But in the NFTs, either you own 1 NFT of that particular art or you do not own it. It cannot be broken into smaller pieces because these are non-fungible. Got that?
So they cannot be broken and they can be broken into pieces. Is that the kind of
Broken means even after breaking it, the values are identical. What I am saying, value, if I say I give you 100 rupees note, or if I am saying I am giving you 1 rupee coins, as per the Payments and Settlement Systems Act, as per currency, all those exchanges, you are bound to even accept that 1 rupee coin. Even if I give you 100, there's a denomination, I won't give you 1 lakh rupee in 1 rupee coin. But up to 100 rupees, if I give you 100 coins, you are bound to accept it. Because you know that even 100 rupee note or 1 rupee into 100 coins are having same values. That because the measure of values are fungible. Okay. 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 Store of value. So what is the meaning of store of value? No.
A person does a work and his salary is value is उसका जो काम है वो value में store हो गया जो उसके काम.
Basically, we can hold, and from here we come to know about time value of money. Savings. Time value of money. We know that the money can be stored and with time its value would increase. And there the concept of interest comes into picture. If there is no store of value function of money, nobody would be storing money in their FDs and RDs, because they will feel that with time the money would get eroded. Why not spend today? You keep on adding. You create your net worth, liquid net worth, based on your value. That is store of value. That is, are you getting it? Because its values can be stored and its value increases with time, and that from where their banking system and banking time value of money, interest and discount rates come into picture. Don't go deep. Okay, we need to have that cutoff in banking, else it is very difficult to cover this thing in 3 hours. Standard of deferred payments. Exactly. Any transaction which can be settled, the transaction happened today but the settlement would happen in future date. Transaction today, like credit on loan. From this function, there is a concept credit and loan came into picture. Else what would happen if there is no standard of deferred payment? Would you be able to get a loan? Because of standard of deferred payments, you did the transaction today, but the final settlements would happen after some other day on a future date. But if you talk about all these features are also acceptable in case of cryptos. But is cryptocurrency a money? See, if these features are also getting satisfied by cryptocurrency.
It is not fiat money, but It is money but not legal tender.
Exactly. Everything, it has all the features of money, medium of exchange, standard of it, store of value, store of measure of value, but it is not a legal tender. The moment it is accepted as a legal, no. Money has to have that legal tender acceptance. Else that becomes an illegal trade, grey market.
Crypto is fiat, na?
Crypto is not fiat. Crypto is not fiat. Nah. See, I can refuse to accept crypto. Fiat has this, that is a hard currency, that has global acceptance. If all those transacting parties, specifically if Bank of International Settlements, BIS, accepts this as a medium of exchange, as a fiat currency, it would become a fiat currency. It has started, Donald Trump has said that we will have a reserves of crypto as our foreign exchange reserves. That is why we saw bounce of that 10% hike in this crypto Bitcoin's price. So gauge that thing. Everything it is getting satisfied, but that is not a legal tender. So money has to have a legal tender. Why? Because it has to have a particular monetary policy regulator to control the money supply. Cryptos, it is very difficult. And that is why they have brought in another concept, CBDC. CBDC is kind of crypto, but that is not decentralized, rather it is centralized. But it has all the features of cryptos. Okay, e-rupee, whatsoever you say. So is e-rupee a kind of crypto? Yes. Is e-rupee a legal tender? Yes. E-rupee is a legal tender. E-rupee works on blockchain technology. E-rupee, you cannot refuse e-rupee if it is in circulation like NEFT and RTGS. If someday e-rupee also becomes as acceptable as normal transaction, then you cannot deny e-rupee. That is that, but that is not decentralized. That is a central bank digital currency. Central bank means it is centralized. Okay, these are the small fine prints that you are required to know in case of prelims examination. Got that? Okay. So obviously money, what is money? Is money a stock variable or a flow variable? Fast.
Money stock.
Money is a stock variable or a money supply, basically money supply obviously. Stock variable or a flow variable? Stock variable. It's a stock because at any point RBI comes up with a data, obviously at end of fortnightly they release these data, M0, M1, M2, M3, M4 data. Okay, so M0 is high powered money or reserve money or monetary base. So what is monetary base? It's currency in circulation plus bankers deposit with RBI, basically RBI's liability. Straight away you just see whether RBI has certain liabilities, it becomes the base, monetary base. So in that you have currency in circulation. So what is currency in circulation? Hey, don't say demand deposit. Currency is not demand deposit. Cash in hand. Then you have another thing, I would say there is another word, currency with public. These are two different things then. Had that been said, they would have written as currency in circulation. In M0 also, M1 also currency in circulation. Why they have written currency with public then?
So liquid in market.
Be specific when you are saying. Currency in circulation means whatsoever currency which has been circulated by RBI. The RBI has just printed it, has floated it in the market. RBI does not know who is the owner, who is actually holding that currency. So currency in circulation or CIC I would write, it would be better. Currency in circulation would be having two components. One is currency with public and currency with banks. Either the money would be, either it would be with public, it would be with normal public, or it would be in the vaults of normal businesses. Normal businesses, they have their money in currencies in their vaults also, or it could be currency with banks. But whenever we talk about only currency in circulation, it is high powered because this is the liability. RBI does not know whether that currency has gone, whether you are holding that currency in your wallet or is it lying with the vaults of the banks. RBI is not bothered about that. But what RBI is saying that if it is currency with public, it would go into M1, that is narrow money, but RBI is silent about currency with banks. Why is it not counting currency with banks? There is no mentioning of currency with banks. See, I won't teach M0, M1, these are the components, those things, smaller things which would be quite confusing. This is what I will attack. These are standardized things. It would be available in all those standardized textbooks also or internet also. But the thing is, these things you are required to know here. Currency in banks, why RBI, why there is no mentioning of currency with banks? Shri, are you also getting it? What I'm asking? Okay, so currency with banks, why is this function or this particular thing not mentioned in any of these metrics, M0, M2, M3, M4, M4? Double counting. Because that currency in banks either would be demand deposits or it would be time deposits. How would you credit that thing in your accounts if that same thing is not having components in vaults? It would not be equal. Obviously the deposits would be way greater than currency with public, but the currency with public would have been accounted, subsumed in currency in the deposits, total deposit base of the banks. Getting it? The moment we have counted demand deposit aspects, obviously some components of currency with bank have been subsumed into this.
So why we haven't counted time deposits here?
No, time deposits is a broad money. It has been counted here. Why it is not counted in M1, we will discuss now why it has not been counted in M1. See, I will keep on, let me cover this topic holistically. I guess you will be having all your doubts cleared. Okay, just wait and listen, because the things would be available in the notes. It would be the only small pointers you are required to point it in your notes, that's it. So what happens? Why do we have classifications? The classifications have been brought in so as to make sure that how quickly things can be converted into cash. That is what, how quickly all these items which are available can be converted quickly into cash, because at times whenever transactions are proceeded with, it is all about cash. Even if you have taken loan, the money moves from X party to Y party, that settles in cash itself. Even a party A has taken loan and has bought something, the party B would be receiving cash. Cash, I'm not talking about currency, it could be bank deposits also, but they would not say, okay, I have taken loan, you take that loan from me. It's not that case. You take the loan, you take the liability, I need the cash. So how quickly those things can be converted into cash is known as liquidity. It's known as liquidity. The more liquid the asset, the closer it is to cash. Cash is the most liquid item. The next most liquid is gold. In international finance, the next liquid item is gold. Third most liquid item is demand deposits. Demand deposits. Fourth is government security, specifically treasury bills, T-bills. You are not required to go about the which is a, I'm just saying how quickly, and the most illiquid item is your property, your fixed assets, immovable assets. That is why whenever you have declaration, it is movable assets and immovable assets. It can be converted into cash, but it will take time. Even you may lose out on the values also. There are value risks associated with immovable assets, but that is not the case with cash. Cash is rupees 100. Even if your grandfather had that 100 rupees, that is still 100 rupees. Even though it has lost its time value of money, but it is still 100 rupees. That is the holding of that particular cash. So liquidity is going down. Liquidity is going down, or it is decreasing as we move from M0 to M4. So what is narrow money? It's all those deposits which can be quickly accessed, which can be accessed on demand, which can... No, M0 is something ekdam different. It is totally different. Yes. M0 is totally different thing. It is the monetary base. It is the monetary base. What happened? M1, M2, M3, M4 is declared, but obviously you are also the RBI is also required. You also spell out your liabilities. So they say that rather than, because that is the most liquid, because RBI holding CRR, deposits with banks are CRRs. Currency issue by RBI is the most liquid. So they say that if they keep this at M5, that would not suffice it. So they have created M0. Money supply is technically M1, M2, M3, M4. But they know that the reserve money or the high powered money is the most liquid because they are the currency issuer. They are the one which are multiplying money multipliers. Who are the money multipliers? RBI. RBI through its reserve operations, CRR specifically, they create money in the market. And that is why, what happened? Okay. So it is all because of RBI. So that is why they have set M0. Liquidity starts from M1 and it goes down till M4. Highest liquid is M1, lowest liquid is M4. So M1 and M2, if you just combine, you will have those demand deposits. It could be the commercial banks or it could be post offices.
So why post office bank kept
Separately, that is there. They also have certain banking facilities with them. You can open a post office bank accounts with them. That is how the dealing of post office with RBI is different vis-a-vis the dealing of scheduled commercial bank with RBI because of Banking Regulation Act, because of RBI Act. Because post offices are 100% owned by Government of India. And that is, but the money is similar in nature. Even if you are holding money in demand deposits are nothing but savings and current account. That is also known as CASA. So demand deposits are nothing but current account and savings account. And it is very important because it is this particular account which creates highest margin for the banks. Don't go deep. How they fund, source of fund and application of fund. That is the idea of banking business. How they are sourcing that fund, so that they'll be ready to open a current account if you have a valid document, because they are not required to pay any interest on the current account. In the meantime, the moment you have higher deposits in current account, they'll channelize it as loan, and they will earn whole lots of margins. Okay. So narrow money is anything which is demand in nature. What is the meaning of demand? It can be demanded anytime. Whosoever is holding the deposits, whosoever is the owner of the deposit can demand it anytime. And the demand can be through various settlements. It could be asking through deposits, cash, DDs, whatsoever. There are various mediums to ask your deposits. Of late, we have also created digital means like UPI, like your demand NEFT and RTGS. You are basically accessing your demand deposits through these mediums. It can be demanded any. So that is why it is known as narrow money. Broad money includes the time deposits. So time. M1 is most liquid. Most exactly. They are liquid, and M3 and M4 are less liquid. Okay. Because these time deposits, if you talk about the net time deposits with banking and other deposits with RBI, it includes the whole of things. So here you are also including things which you cannot access instantly at your demand. For example, if you have fixed deposits and recurring deposits, the bank can deny you instant settlement. If you are breaking within your contract period, the banks can penalize you. They can say that they can refuse your settlement at that time. That is why it is time deposit. There has to be you have agreed a contract, you have signed a contract with the bank that you will use it after the maturity period expires. And that is why it is known as time deposit. So obviously it is M1, M2, M3 and M4 liquidity terms. And this is why it is narrow money and broad money. Broad money, Broad money basically includes all types of, so broad money does not, M4 or M3 also includes M1 part. And M4 also includes M3. So in a way M4 includes M1, everything. You should not get confused that it is only
M3 doesn't include M2.
M3 is not including M. M4 is including everything. M4 is including everything.
M4 may be M2 नहीं. Savings deposit.
Okay. But they are talking about total deposits of post office banks. Okay. M4 includes everything. Now we have money multiplier. So money multiplier is broad upon monetary base. Monetary base. That is M3 upon M0. It is also known as 1 upon CRR. What is money multiplier? The question is, what is money multiplier? This is a formula, but what is money multiplier? How many of you actually read money and banking class 12 chapter in NCERT? Obviously I'm talking about NCERT.
So money multiplier means how that particular M0 is expanding to become M3, sir, over a period of time.
Or either are you talking M0 is expanding to M3, or you are saying how M0 is actually is being used to create many multiples of money.
Yes, sir.
Basically M0 is not getting converted to M3. The idea is how M3, or basically controlling that M0, you are controlling the number of multiples of M3. So how does it proceed? The question is, how does it proceed? How M0 or 1 upon CRR is leading to many multiples of money?
Banking operations.
How?
डिपॉजिट कर रहा हूँ, मान लो 100 रुपीस डिपॉजिट कर रहा हूँ, उसमें से कुछ CRR के बाकी उन्होंने किसी को लोन में दिया,
Okay.
तो वो जो लोन में दिया एंड जो डिपॉजिट है वो बेसिकली 190 के आसपास हो गया, तो स्टार्ट 100 से हुआ था, M3 M0 से बन गया 190, तो उसका रेशियो ऐसे
And that creates an infinite geometric progression series. If you are comfortable with class 9th 10th, I guess GP you would have learned thing. One infinite summation series of geometric progression. Why is it a geometric progression? Because you are actually, what is this ratio is, if suppose 10% is the CRR, I am not talking about the actual CRR, if 10% is the CRR, so basically 100 rupees is your initial amount and your ratio becomes 0.9. 0.9. So AR square, if you know the formula of that, AR cube, AR raised to power n minus 1. And if it is infinite times, you create an infinite summation of geometric progression, and the formula of that is A upon 1 minus R. This is the sum. Basically you are summing up things. Cumulative series. If you are talking about cumulative, what is?
1 minus R.
1 minus R. So 1 minus R is nothing but CRR, because 1 minus 0.9 becomes 0.1. This is your initial CRR, and that is why it is known as 1 upon CR. How?
0.9. No, 0.9. What was it?
See what happened, you took 100 rupees, next time it became 90 rupees. Then next time it became 81 rupees, because you should debit that 10% every time it should be deposited in with RBI as cash reserve. So every time money, the same 100 rupees, 1 minute, just listen me, you will just get to know what I am saying. That 100 rupees initially you had 100 rupees, next round the same money went again to the bank, because using that money you settled it with a transaction, and that particular person also went to bank and deposited how much? 100 rupees, but the banks would again use 90 rupees because 10% goes to CRR. Next time 90 rupees gets converted into 81, And infinite time, if you keep on adding 100 plus 90 plus 81 and whatsoever, if you go down the line, you are creating an infinite geometry progression series where the ratio is 0.9, but 1 minus r is basically your CRR. Getting it? 0.9 is your factor, the ratio factor, but I am saying 1 minus r, so 1 minus 0.9 becomes 0.1. This is basic maths. So what is the initial premise, that 0.1? How did you get this 0.1? This was your CRR. This was your CRR. If CRR became 5%, so it would be 0.95. And again 1 minus 0.95 becomes 0.05. So basically CRR becomes your reserve tool. Just changing CRR changes money multiplier.
How do we get 1 by CRR? Sir, can you please repeat, sir?
This is what saying. The formula is A upon 1 minus R. Formula is A upon 1. How is this formula, how we are able to get this formula? You go and just search infinite summation series of geometric progression, you will get A upon 1 minus R.
Yes, that is okay. It is 1 by CRR. Why do we denote it as money multiplier? I'm asking.
That is what I am saying. Okay, just erase this thing. A upon 1 minus R. Here we talked about R is ratio. So,
Cash reserve.
no, not cash. Don't get confused. Cash reserve. R is that ratio by which the progression is moving.
Okay, sir. Okay, sir.
AR square till infinity. This is your summation. This is your series, which is R is the factor. In that case, if you had taken 100 rupees as initial, that became your A. R became 0.9 because you had taken CRR as 10%. So every time only 0, it was a decreasing function geometric series. It was not an increasing series. It was a decreasing series. So R was reducing. It was getting reduced by 1 by 10, 1 by 10 every time. So 1 minus R became, you could have written A upon 1 minus 0.9. So basically it became A upon 0.1. So you could have written as 1 upon CRR into whatsoever is the multiplier, whatsoever is the initial deposits. Getting it? You just listen to this again, because what would happen, it is a very long class. We will have many more concepts. Don't get entangled in the concepts. What I am saying, why is it so? There is a premise of this. In December, you will have this thing in your notes also. In December 2024, in the monetary policy review meeting, in December, there is another meeting that happened in February. RBI reduced its reserve ratio by 0.5%. From 4.5%, it reduced to 4%. CRR reduced to 4%. So if a statement comes, it would inject liquidity or it would absorb liquidity. By reducing CRR, what would be the effect on the market money supply? It would inject liquidity. Expansionary policy. So the expectation was it could have created, by just reducing 0.5% CRR, it could have created liquidity worth 1.16 lakh crore in the economy. This was the premise. It's there in your note sheets. You just read prelims corner, niche mein there would be a notes there. Why this is the way they are multiplied. So using CRR, they are controlling the multiplier. Got that? Don't stretch it, because there are many more concepts to come.
Inverse relationship.
Inverse, obviously 1 upon CRR itself becomes inverse. If you reduce CRR, liquidity would increase. Money multiplier in banking terms is known as liquidity. Liquidity. How you are controlling liquidity? Either through repos or cash reserves. Okay. Let's go quickly. I told you we have to touch upon many of the things rather than delving too much into a single thing. Okay. Demand deposits can be demanded anytime. Can be demanded anytime. Once you use your savings account and you do the transaction, there could be certain failures, but that is all because of server issue, not because the banks have refused to settle your payments. If you are using your UPI, you have all the rights to use it anytime. You are demanding money from your deposits. So that is technically current accounts and savings account. savings account. Of late, earlier it used to be demand deposits also, DD, but it is now not in use. In some of the universities still they ask for DD as a mode to settle your fees and all these things. Don't know why. Time liabilities, this is a contract with bank. You have said that you will not use the money for that much period, and since there is a contract, banks give you higher interest rate. And if you do not honor the contract, you will be penalized. Suppose if you had FD for 5 years, in the meantime you break FD for after 1 year only, you will be penalized. Okay, and what is the calculations? Don't go deep. Okay. Other liabilities which do not fall in these, there could be certain unsettled claims, unsettled dividends claim, these all come under other liabilities. Dividends are actually credited in your bank account. If you are not claiming the dividend, it goes into unclaimed deposits. Udgam is that portal, I guess. Unclaimed deposits portal. Udgam portal. We have covered some of these things in the current affairs PGP class. So I am not going deep into these things. Okay. Whatsoever were there, we have covered that thing in PGP.
So when is unclaimed deposits go to, sir?
There's unclaimed deposits. Technically, what happens? There are two ways. Unclaimed deposits are given. There's an escrow account which is created. Either it is created with RBI, and the banks are actually required to access it before. But the main condition is they need to have a diligent KYC. Whosoever is the claimant. Okay. Don't go deep, please. This won't be asked. That I guarantee. UPSC would not test your these knowledge. They won't be testing you. They will test you time liabilities, why time liabilities are called so, and what are demand deposits. I guess they won't even ask in your RBI grade B also. RBI grade B also has huge syllabus. Okay, RBI. Now, there are two acts which is very important from the perspective of banking. One is the RBI Act, other is Banking Regulation Act. The RBI Act and Banking Regulation Act. So RBI Act gives authority to RBI to act as various functionaries. One of them being the monetary policy regulator. Monetary policy regulator. The power is derived from RBI Act. But as banking supervisor and banking regulator, the powers is derived from Banking Regulation Act. So the statement, if it comes out, you need to know this thing. Okay. RBI has different functions. Issuer of currency, bankers to the government, forex manager and all these things, inflation control. These things are derived from RBI Act. But RBI penalizing banks, RBI appointing directors or removing or giving restrictions in case of, like currently they had certain restrictions on Yes Bank was merged with many. There are many restrictions which are there. Licenses, if a particular new license has come or any branch of bank, new branches have to be opened, there are certain ratios that these many branches have to be opened in rural areas also. There are certain mandates. So these regulations are, because these are banking regulators. RBI acting as a banking regulator. It derives its power from the Banking Regulation Act 1949. Okay. These are the two important acts as far as the banking system is concerned. Okay, so RBI Act ensures the RBI role as monetary policy regulator, and there are two more things. We'll talk about this thing. We have two things, CRR and SLR. The power of CRR and SLR are different from, they are derived from these acts only. CRR, SLR from Banking Regulation Acts. Okay, we'll deal with that thing in afterwards. That is why if any banking institution, any, they can be mandated to have that CRR. They can be relaxed with SLR, but CRR, if you are taking deposits, you will be slapped with CRR. This is the only thing. So any prelims question that comes in, if it is applicable, CRR is applicable, you just think from the whether that particular entity is taking deposit or not. If that entity is taking deposit, CRR is 100% applicable. 100%. There are two ways CRR, we will talk about this, whether it is scheduled or non-scheduled. Because what has happened in banking, this UPSC has gone deep into these things. They have gone deep into these things and asking, rather than asking repo rates and reverse repo, they have gone into MSF, SDF, and even to that level of whether CRR is getting derived. Like last year, all NBFCs are allowed to take access that liquidity window adjustment. Who would know these things here? What is the purpose? And they suppose this thing comes up and there is an economic crisis and RBI opens that window to it. RBI keeps on changing these things. Then UPSC would say, sorry, I should not have asked these things, where RBI has the regulatory power to keep on changing these things. They come out with directives after every 10 days, 15 days, that depends. So they had this LTRO, we will talk about this. So there was this question, how this question came. LTRO was something which created this confusion. Okay, so these are the functions of RBI. So RBI has 4 functions. One, monetary policy regulatory function, supervisory function, and facilitatory functions. Regulatory functions, supervisory functions, and facilitatory functions. Facilitatory is very easy, developmental roles. Financial education, financial literacy, PSL, and all these things are developmental roles. Financial inclusion index, they have brought in this FI index and all these things. These are developmental roles. What are regulatory functions and what are supervisory functions? Suppose these are the functions which are given. How would you say that some of these are regulatory, some of these are supervisory? Are you getting the question?
Yes. Supervision of the bank.
Exactly. Whenever RBI is having a stick with them. If you are not doing this, we will slap a fine to you. Supervisor. Supervisor always has a stick. So that is why it is carrot and stick policy. Whenever RBI adopts a stick policy, it is supervisory. Perfect. Whenever RBI invokes certain regulations as per the acts, it becomes a regulatory function. Got that? And what would be supervisory and what would be regulatory? Banking related activities, generally it is supervisory. But banks overall, not mandating, not following some of the regulations of RBI. RBI is monetary policy regulators. That is regulatory function. They would be slapped with regulatory, you can say they are not violating regulatory norms. XYZ banks slapped with ₹1 crore for violating supervisory norms. XYZ banks slapped with ₹1 crore for violating regulatory norms. You will come across these news in newspaper. We just flip this thing. Okay, this is non-essential from UPSC because there is no term associated with it. For example, if Yes Bank it opened 5 branches in tier 1 cities and there was a mandate to open 10 more branches in tier 6. They have various, up to tier 6, tier 7, they have these tiers depending upon the spread of banking facilities. So if the same number of branches was not opened, then Yes Bank would be slapped with supervisory norms. But what if there is SLR quota which has to be maintained 18%, RBI checks it fortnightly, and it was found out that they have slipped into that thing and the SLR quota, rather than 18%, they are maintaining at 16%. That is violation of regulatory norms. They will be slapped with penalized. They will be penalized. Supervisory, recent example, Paytm Payments Bank. They were told to disclose your things, XYZ things, because RBI felt that the money they are getting it is creating certain issues. They were warned, they were done, and again stricken off. The license got cancelled. Supervisory, violating the supervisory norms. Regulations should always be derived from the legislative frameworks. Because first is act, then comes rules. And the rules are well within the ambit of RBI to frame, because RBI is that regulator. It is not every time they'll go to parliament and say, I want to increase the repo rate, and parliament meeting would be convened. It would become the most restricted system in India. Every time parliament is being called for even changing the repo rates. So that is why they have been given the powers, regulators. But supervisory, the banking system, there are certain norms. If they are violating, that becomes supervisory. Forex derivative, supervisory. Yesterday or today itself, RBI has restricted IndusInd Bank. Today you go and see the shares of IndusInd Bank, it has crashed by 25% today itself. 25%. So what happened? I'll just give an example. Why? Because you need to connect with the recent examples also. So our IndusInd Bank goes into forex trading, foreign exchange trading also, and derivative trading. And they were required to also release the valuations at which they were doing it, and they were just under-reporting the valuations to inflate their earnings so as to make sure to show that their banking system is doing good, the profits are better. But once it was found out that they are actually changing, manipulating the valuations at which they are doing it, it was found out that in the next quarter RBI would be slapping them with certain penalties, and they will incur losses because they need to book the losses then. If it is found out that it is loss, it is a loss. You need to account for the loss, and that is why they have been penalized. Supervisory norms, the RBI, the IndusInd Bank director was not given extension. The chairman was not given extension. Straight away he will be going with certain RBI officials who will be visiting him. Chanda Kochar arrested, violating the supervisory norms. That is supervisory. Regulatory, regulations, specifically CRR, SLR, whatsoever it's there. Done. These things are standardized, you will get all the information in your sheets. Okay. So there are two functions, one banker to the government and lender of last resort. What is the difference? Exactly, this is the only difference. Lender of last resort, the accessing party is the bank. Bank is saying that I am just going down, you please help us. Bank crisis, basically. Bank crisis, lender of last resort. RBI would come out with innovative tools to save the banking system. It would be over and beyond whatsoever is allowed, because RBI has this power. RBI is IAS. IAS is also bound by constitutions and laws, but still IAS also has discretionary power to take certain decision. No one can ask that why this decision was taken. In the same manner, RBI is also bound by certain acts and all these things. Still, RBI also has certain discretion to save the bank from collapsing. Else, it would create a systemic risk in the system. Because the bharosa, the trust of the people would be lost, and everyone would queue to the bank, please give our deposits. It would lead to bank run. Okay. I am banker to the government. What is the meaning of this? Banker to the government? Exactly, like for example, ways and means advance. Exactly. Ways and means, and whatsoever bank, just like a particular party is having transactions with bank, RBI would be having accounts of Government of India. The consolidated bank fund of India, the accounts would be managed by RBI, but the agency is SBI. That is what I was just having a conversation. SBI is the agent of RBI. So SBI would be working on behalf of RBI, but actually the dealing is between RBI and the governments. It could be the central government, it could be the respective state governments. So whatsoever thing is being done, the government securities is being floated, state development loans of the state governments are being floated, it is the banker to the government function of RBI. Okay. Rest, everything, lender of last, banker to the government, currency issue, it's clear. Foreign exchange management, the BOP and all these things are maintained by RBI. Okay. Forex, what?
Some rupee coin is issued by the finance minister.
No, there are certain 1 rupee coin. These are trivial information. I am just not knowing which. I guess 1 rupee coin is issued by finance ministry or something like that. You go and check this. This is trivial information. I guess they won't be asking. Still, 1 rupee coin I guess is issued from the mint. There are 2 mints. One is by the RBI.
That is from Coinage Act.
Coinage Act. The souvenirs, coins, stamps are from different acts, but issuer of currency is from different act.
Currency, RBI Act.
RBI Act. Okay. Financial stability and all these things. Money market regulation, we'll talk about this thing in capital market and money market. Okay. Their money market regulator is RBI, capital market regulator is SEBI. We'll talk about this, what is money market, capital market in capital market class. So monetary policy. So monetary policy core mandate is growth with price stability. Growth with, what is growth? Economic growth, obviously. Economic growth with price stability. This is the mandate of monetary policy. Okay, what is the objective of monetary policy? There should be growth, economic growth. At the same time, there should be always an eye on the price stability, the inflation part. Okay. So growth and price stability, it is done by two agencies. One is government, other is RBI. If our government is doing this thing, it is known as fiscal measures. If our government is doing these things, it is known as fiscal measures. Fiscal consolidation is another part of fiscal measure. Fiscal measure is first part. One, the debts are beyond thing, then you go for consolidation. We'll talk about this thing in budget. Okay, and if the RBI is doing this thing, it is known as monetary measures or monetary, whatsoever policies with the RBI is making is known as monetary policies, and the measures are known as monetary measures. But what happened at that time? So the genesis of monetary policy committee, why it was created, it was found out that at times fiscal measures were not in sync with monetary measures. So it was all about whether you are looking at this as your priority or this as your priority. So technically government, what would be the core function of the government? They will look more at the growth, nominal GDP and all, everything is linked with nominal GDP and all these things. But monetary policy would be looking more at money supply. So obviously there would be a divergence at times, and that who would be the receiving end? The public, general public would be, and the economy would be at the receiving end, and that has happened pre-MPC era. Specifically from 2010 global financial crisis, the reaction or the steps which were taken was all about making sure that the economy does not collapse, and in the meantime what happened, that the money supply was extended like anything to make sure that the growth is very high. But that created growth with inflation. You go and check the growth levels of India, it was very good, but that was also coupled with high inflation. Yesterday only we had talked about, if there is economic growth, that would be coupled with inflation. But to make sure, if there is very high inflation, if there is price instability, that creates fluctuations in the system. Why price stability is very important? To ensure the store of value function. Why does currency collapse? Example, Zimbabwe, they have been brought out, I guess, 10 currencies in the past 10-15 years, because the store of value functions go for a toss. That is done. They want ZIG, they have brought in, Zimbabwean dollar, backed up by gold. ZIG. Why? The store of value function is eroded. Connect with the functions. It is easy then to create something. So if the store of value functions get eroded because your inflation is eating up your appreciation, and the purchasing power goes on reducing. So over a long period, what would happen? There would be short-term growth, but that can lead to a problem of stagflation. What is stagflation? We'll talk tomorrow. So that is why it created an independent monetary policy regulator, independent committee, which was called as Monetary Policy Committee. Okay, so there the government also, obviously government wants to have say in all these things, and once this fiscal council was talked about, so like Monetary Policy Committee, we also should have fiscal council. The government categorically said that we are not in mood to bring out any fiscal council. Okay, we'll talk about this thing in budget and all these things. Okay. Independent regulators should be there, independent monetary policy committee should be there. That should be data driven rather than populism driven. Okay. So control inflation, at the same time sustainable economic growth, and that is why we had created a monetary policy committee and inflation targeting regime, and we have been following this thing, inflation targeting regime. That is an agreement between RBI and the government of India. RBI and government of India. It was created. Why? Hello? Yes. Fiscal Council. Obviously, what happens? Government all do not want to share their powers. Like judiciary did not want to share the power, NJAC was scrapped. Everywhere you will have an independent regulator. Independent regulator means experts would be sitting there. And once the organs of government feel that their regulatory powers or their powers are being snatched by an independent particular committee, they'll say that we have a basic structure doctrine, we are independent authorities, we are executives, and whatsoever independent autonomous regulators would be there, they'll make sure that their person sit there. This is polity, this is not economics, but still. Obviously the core thing was the monetary policy and fiscal policy should go in sync. In sync. Rather than there should be a divergence. Suppose there is very high inflation. Suppose there is very high, and if there is no monetary policy regulator and monetary policy committee, and there is no agreement between the government and RBI. High inflation, RBI would say we are increasing repo rates, obviously to tackle inflation. At the same time, they would say, fail to detect.
So not able to see the board, sir.
You are not, am I audible?
Sir?
Am I, just ask anyone who is sitting outside. 1 minute. Am I audible? You are not able to see the board. Wait a minute. Wait a minute. Are you getting it? The things you are getting it? Because this is very fast. It has to be fast. It has to be fast. Else, फिर वही चलेगा. Foundation class बन जाएगा फिर. Foundation class. I don't want to make it a foundation class. It has to be a process. Processing should be very fast. So because of this thing, in 2016, I guess, this monetary policy committee was created under inflation targeting framework. So framework was created to have growth with price stability, and a corridor should be created, and that corridor was 4 plus minus 2% based on CPI combined. Based on CPI combined. What is CPI combined? What is all these things? We'll talk about tomorrow. Okay. Technically what happens? Inflation and banking and monetary policy should be there, then banking, because but the syllabus itself becomes so stretched, that is why it has been done so. Okay, so what happened? So we have 6 members, 3 from RBI, 3 independent experts. It is not government, it is independent experts. Nominated experts, but that is not government of India. Basically represent executive members are not getting appointed by government of India. Okay, and one of them is RBI governor. One more thing, it only looks into repo rates, policy repo rates. But whatsoever changes in SLR and CRR would be from RBI itself. Don't get confused. RBI. It has only taken repo rate. It would only take call on repos. What should be the repo rate? And that is why now repo rate is also known as policy rate. None of the other functions have been snatched from RBI. Only calling the policy repo. What should be the voting? The voting is done in a pattern that it should be voted based on majority. The majority could be obviously 4-2, 5-1, 6-0. But once it is 3-3, there has to be casting vote. In case of a tie, RBI governor takes the second round voting, and whatsoever is the decision of RBI governor becomes the decision of monetary policy committee. It has never happened, I guess. Never ever a casting vote has to be required, because that gives a signal that the government, the independent, there's a divergence. There's a divergence. But this time, I guess for many years, for the first time, in the February monetary policy, it has been 6-0. Unanimous decision. Cut the policy rates. Okay. Technically, one or two members are actually having certain divergence. So this is the idea behind inflation targeting framework, and this has been incorporated in RBI Act 1934. So this becomes a statutory body. It has been incorporated. It's not an executive body, it's a statutory body, deriving its power from RBI Act.
Are there government members inside it?
I'm saying independent members, experts. Technically, these are experts in the field of finance. IIM Ahmedabad directors and all these things are actually there. Okay, they need to have certain background in finance. So this is the meaning of casting vote. So inflation targeting framework, always this is reviewed after 5 years. So the current cycle is 21 to 26. And we have a band of 2 to 6%, that is 4 plus minus 2%, based on CPI combined. Why I have written combined? Because there are various types of CPIs.
All India like same in all India.
All India CPI, but all India CPI is for agriculture, labor and industrial workers are also there. The idea is this CPI combined is released by NSO. But agriculture, labor, industrial workers are released by Ministry of Labor and Employment. Labor Bureau specifically. Okay. So they target CPI combined released by NSO. And if there is 3 consecutive quarters, if they breach that mark, they are answerable to the government. They need to say why they have come out with this. And that is why in I guess 2022, there was a mid-term policy review also. Over and above the bi-monthly policy review, the policy rates were increased rapidly by 50 basis points or 100 basis points. Because they were in line, the inflation was not going down, and there was a position that for 3 consecutive quarters, India's inflation would breach that mark of 2 to 6%. So they increased the repo rates extremely by a tremendous number. Technically, they go for 25 to 50 basis point cuts or increase, but they moved by 100 basis points. Else, it would have been an issue. Now, post-pandemic, all the central banks have an agreement of global disinflation. Global? What is the meaning of this? Post-pandemic, pre-pandemic, pandemic, post-pandemic. Pre-pandemic, business as usual. Pandemic, there was sudden loss of business and there was a situation of deflation. The demand was not there. So, the policy rates were cut to ensure there is a growth support. But once the business resumed, there was a huge demand that is known as pent up demand. So what is the effect of pent up demand? And what was obviously that has happened? What was the effect of pent up demand? There was huge inflation. Huge inflation because of obviously demand supply mismatch. And that led to inflation exceeding the comfortable zones. So globally all central banks embarked upon disinflation regime. Tight policy, monetary policy. Worldwide, repo rates and whatsoever is the benchmark rates of those governments, they increased it tremendously even beyond whatsoever is there required. And this process is all about to reduce inflation year on year, not to again enter into deflationary zone, but to reduce inflation year on year. This is known as disinflation. Through tight monetary policy, and this is also known as hawkish approach. This is also known as hawkish approach. We'll talk about this thing. Okay. Now, how do they go about these things? What are the tools? So the first tool which is not in used, not in use, that is not used, still they come out with the rate, that is bank rate. So bank rate, so there are two sets of tools. One is quantity.
Sir, RB is a part of SBI, na?
RBI?
So RB.
No, who said this? As RRB is
Yes,
there.
RB, which original.
RRB derives its power from RRB Act 1976. SBI derives its power from SBI Act 19. We will talk about this in banking part. It is just and there is another nationalized banks, public sector banks. They derive their power from 1970. One act was in 1970 and another act was in 1980. Don't get RRBs. We'll talk. RRBs are a special category of banks which has a sponsor bank, which is technically a public sector bank, and also holdings from central government as well as state governments. So all three entities are owners of RRBs. The condition is they need to cater to the rural economy, rural development. None of the RRBs would have any presence in the urban areas, cities. Okay, that is the only thing. The power they derive their power from RRB Act 1976.
Commercial bank
Exactly what I am saying. So repos, commercial banks, I would say they are accessed by scheduled banks. You're right. Scheduled banks, and those scheduled banks could be commercial, cooperatives, developmental financial institutions are non-banking financial institutions. Any bank needs to have deposit as one of their activities. If a bank is taking deposit, that becomes a banking entity. It needs to have deposits, and the moment it has accepted deposits, it needs to comply with regulatory frameworks of bank, basically CRR. And the moment scheduled banks, and what are scheduled banks? We'll talk about this later. First you understand, repo rate becomes the benchmark policy rate. It is the loan which is given by RBI to banks, and banks give them collateral. And after the repo period expires, the contract period expires, the banks are required to give back the loan as well as interest, and the securities are again given back. However, you just keep in mind, there is no physical movement of security that takes place. The securities remain with bank, only that much securities are blocked. What is blocking? Obviously, using that thing again, you go to another institution, that would become bank guarantees, Hawala scam, and what that scam? 1992 scam. Using the same paper, you are going and taking multiple loans. The securities are blocked. The idea is, if there is any interest payments, that would accrue to the banks, not to RBI. Did you get it? See, if you are holding any security, you will get any coupons, interest and all those things. That would remain with bank. So technically, owners of those securities are banks. And any incomes which are getting derived, that would accrue to banks. The securities would not physically move, only that would get blocked, and after the repo operations, it would get released. The same thing goes opposite in case of reverse repo. Reverse repo. So the current rate is 6.25. It has been reduced from 6.5 recently in February 2025 only, after a gap of 4.5 years. We have seen a repo rate cut. The last cut was, I guess, in 2020 May 2020. The repo rates were cut. Okay. Then reverse repo. Now one more thing. Reverse repo, technically it does not happen on a fixed rate. We have a fixed rate, that is reverse repo rate. नहीं, किसने बोला रेपो का नहीं है? नहीं, you'll just get to what I'm saying, you'll get to know. If any transaction between banks and RBI, if the banking system is taking loan and it is being taken at repo rate, the rate would be at the prevailing repo rate. But the reverse repo rate always has variable reverse repo rate. It is done through auctions.
So is it not 1% higher than the repo rates or 1% less?
It is, we'll talk about reverse repo rate is always less than repo rate.
Yes, sir.
We'll talk 1 minute. Repo rates, technically reverse repo rate is not used by banks any further. We'll talk about this thing, what is happening with this. See, when RBI takes loan, when this banks take loan from RBI, it happens over prevailing repo rates. Prevailing repo rates. But when banks need to park their excess liquidity, they use another tool, that is standing deposit facility, SDF. So in a way this has not been used. So that is why rather than reverse repo, they have talked about variable reverse repo auctions. VRRR auctions. Variable reverse repo rate auctions. This is used. Bit higher. The basic concept remains the same. If the bank needs to park excess liquidity with RBI would give them certain interest, and in return RBI would give them collateral. So the collateral would be with RBI itself. Again, the same manner, it would get blocked. The interest and the incomes would accrue to RBI only. The physical movement would not take place. But what has been found out, that they do not use this reverse repo. There is another new tool which has been brought in, that is standing deposit facility, SDF.
The only difference is उसमें collateral and
We'll talk about, the moment we'll talk about this, you'll come to know why SDF is being preferred. So variable reverse repo, obviously at 3.35, currently it is 3.35. The RBI would offer 3.35 and they'll say that we want to absorb 5,000 crores. None of the banks would be ready. Sorry sir, we are not ready to park our excess liquidity. We are happy to keep this in our kitty rather than giving you at 3.35. You increase your rate. That is variable. The auctions would be, and at that price where the transaction happened, it is usually very high than this 3.35. So rather than reverse repo becoming the tool to absorb liquidity, it has been found out that this is not being used because the offer is less. Why the offer is less? Because this is collateral backed. RBI is saying that I am giving you security, I am taking money from you, I am the only one which is creating money, and you are asking me to give you interest. Why you are parking your excess liquidity? Because you do not have any business. If you had any interbank call rates, interbank margins and all this, you would have accessed that thing. There are money market instruments, interbank call margins, call, notice, term, where one bank interact with another bank. Talk about this thing in money market. Even use exhausting and looking at different opportunities, you did not find that there is no option to use the money to earn interest. At the same time, you need to pay the interest on deposits. So I am giving you a possibility that you reduce your losses. So that is why I am offering you lower interest rate, but the banks are not ready. So VRRR auctions are generally not subscribed. Repos, sorry, VRR can think that scenario. So RBI said that then what is the possibility, how can we absorb excess liquidity in that case? Because higher the liquidity, more would be the depreciation of currency. They also need to think about the depreciation currency and purchasing power of the currency. So what is the tool with them? SDF. So they have brought out two different mechanisms. One mechanism is MSF, another mechanism is SDF. Similar to repo, reverse repo, they have brought in MSF and SDF. But MSF has a specific quota, 2% quota. You see this is 3%, 3.5%. We'll talk about, first we'll talk about MSF. So what happens? Why would banks be requiring money from RBI? No, to control. Please don't say this thing, control. Banks are not thinking about any inflation. Bank is only thinking about their business. If there is demand of credit is very higher than the deposit base. Source of fund, application of fund. Application of fund is their assets. The loan, if there is higher demand of credit, that is known as credit growth. If the credit growth is very high than the depositor base, the growth in depositors base, because depositors are now very smart. They also have other option, that is equity market. They are, and these influencers have just made them mad. Why are you eroding your money in your FD? Had your grandfather invested that money, you would have become Elon Musk. This is how they sell their mutual fund. First was mutual fund sahi hai, and then came this one person, Amitabh, with a very hard voice. He comes, had you not bought the Maruti Suzuki car in 1982, using that money you would have, if you had bought shares of Maruti Suzuki, you would have owned 10 BMWs. This is the way you try to push your products. This is different. So depositors have two ways. So if the depositors base are down, but the lending in the market is very high, credit growth is very high, so the banks would first they will access interbank call rates. They'll say, okay, one bank may be having higher depositor base and their credit demand would be very low. So they'll say, okay, Axis Bank would say, yes bank, you are having higher depositor base, give the money to us. Short term. That would be short term. I'll use that money for credit. I'll give you the rates, prevailing rates, that is known as call money rates, call rates, notice rates and term rates and all these things. But what if that is also not available? That means the liquidity has dried up in the system. The liquidity has dried up. What is the meaning of drying up liquidity in the system? If there is very high demand of credit, but the liquidity, the free floating money is not available even to the banks or other banks also. Then they will go to RBI, and that is not known as banking lender to last resort. That function is not lender to last resort. Getting it? Bank accessing liquidity, this access facility, LAF facility, that is not lender to last resort. Lender to last resort is, sorry sir, save our SOS button has been pressed, that is lender to last resort. Got that? So the bank would say, RBI would say, okay, you take loan from me and give your collateral, that is repos. But in the meantime, it has been found out that the banks also have securities, which is known as statutory liquid ratio secure, SLR quota bonds, which are not allowed to be used for any repos. Any transaction you cannot allow, you are not allowed to use that thing. So what did RBI say? That we allow you to dip into those SLR quota up to 2%. Whatsoever is your depositors base, that is known as NDTL. Depositors base is known as NDTL, net demand and time liability, that becomes a deposit base. And whatsoever is your deposit base, up to 2% worth of that value, I am allowing you to use that bonds to be used for repo operations. To be used for repo, I am unlocking that 2%. And that is why it has higher rate. Earlier it used to be 2% over and above, now they have reduced, and this is known as policy corridor. We'll talk about this thing. Okay. So now MSF gives them alternate to go and use their SLR quota bonds to take money if there is a situation of dried up liquidity in the system. Got that? In the same manner, this is known as MSF. In the same manner, if there is excess liquidity in the system, excess liquidity means risk of currency depreciation, I would say. We'll talk about money supply only, inflation something different. Currency depreciation, the purchasing power of currency would go down. Currency depreciation, I am not talking about from the perspective of only forex, I am talking about the purchasing power of money. More money chasing few products, that is currency depreciation. Less money chasing more products, currency getting appreciated, the purchasing power of money goes up. Okay, so in that scenario, there would be a loss for banks because they are required to pay interest on deposits. Interest on deposits. And how would they pay interest if they are not earning money on that particular assets? So in that case, that would be a loss, and they are not ready to park under reverse repo because that is not offering them good return. So there was another tool.
Also, the reverse repo is not permanent. Reverse repo rate is not permanent. Announced by
No, that is auctioning. Every year they come out with an auctioning. Nothing is permanent, nothing is temporary. I am saying, if they say that if there is excess liquidity, then only they will access. Banks would not park their money over and above CRR with RBI, knowing this fact that RBI would give them the least interest.
But any people's facility is permanent.
They have been made permanent. They have been made permanent. In the main matter, the idea is there should be another facility which should give them, we should block out that collateral, and if that, this is a more risky transaction than reverse repo. And since there is no collateral involved, the RBI is ready to give them higher rate. 3.33, the same thing is done. 3.35% was reverse repo. And 6% is SDF. What the bank would choose? Obviously SDF, they will choose SDF. So SDF has become the go-to tool to absorb excess liquidity from the system, because the banks are also not at loss. Because even if they park their CASA, current account and savings account, still they are making over and above 3. The savings account deposit rates are 3%, even less than that. Some of the banks are at 2.75. So even if they park their excess liquidity, if there is a business, there is a good thing. If there is no business, still banks are not at loss. Getting it? So earlier,
So it is risky for banks.
it is risky for banks. Obviously, they are not getting collateral, na?
Also, it is guaranteed by RBI.
And that is what. See, I am not saying this will get defaulted. Risk is being gauged from the perspective of whether collaterals are involved or not. Why RBI is giving them higher collateral, higher return? Because RBI is not issuing them any collateral. Why RBI is not issuing them? RBI would be using it for other OMOs and all these things. These collaterals are already gets unlocked for RBI also for open market operations.
They wouldn't profit from them.
And also from the secondary market they get profits. Yeah, they get profits from yield movements. Don't go deep. Don't go deep. It is complex system. How RBI earns money, how RBI is able to give 2.11 lakh crore as dividend to government. RBI is also a company which has a certain transactions, which goes into transacting things in forex market and capital market. In specifically the debt market, they earn money, and if they lock their securities with repo, reverse repo, they lose the chance to earn money from yield movements. Operation twist, there are many other things. Long-term, short-term bonds, how they change the yield curve. Long-term yield curve is through bonds only. Okay. So this gives them the opportunity. So that is why a policy corridor, you write this thing, policy corridor has been created. What is this policy corridor? Policy.
To SDA.
Exactly. So they have set three things: policy rate, SDF, and MSF. MSF at 6.5%. Policy rate currently at 6. This is current value. Don't say that this would remain always, but the policy corridor would remain as it is. And SDF would be. So from MSF minus SDF is currently 50 basis point. So policy corridor is the difference of interest rates on MSF and SDF. Why is it set? Because by just setting policy rate and announcing the policy corridor, everything gets set.
It puts a constraint on the range.
Range. Okay.
Yes.
So this is the policy corridor. The difference between MSF rate and SDF rate. Obviously SDF would be less than MSF.
MSF is decided by?
MSF, SDF, everything is decided by RBI. But what? Through only one policy rate, everything gets adjusted.
So MSF में collateral की requirement है नहीं?
Collateral, that is why they are using a collateral now. MSF is being used as a way to unlock the that is collateralized. That is why they are using SLR securities now. SDF does not require collateral. So that is why it is only 0.25% less than the policy rate. And it gives them, now the banks are ready to park excess liquidity with RBI. RBI says remove the collateral. We are all also happy, you are also happy. And that is why what you are saying, why would they lead collateral? Obviously RBI would not default. RBI would not default, but obviously the collateral is not involved, that becomes unsecured. And the risks are being borne by banks. So the RBI is offering them higher rate than the reverse repo rate. And that is why whenever they go for VRR auctions, none of the banks say that we are ready to give our excess liquidity under VRR. Because if it is set at 3.35, how much it can go above? 3.5, 3.7, up to 4 maximum. Will it reach 6%? Never. Because it is collateral backed. Getting it? Third is open market operations. So RBI, why does RBI want to have that unlocked securities for OMOs?
So who not can access lab corridors?
What?
Commercial bank, RRBs, and who else? What about local area banks?
Local area, see most of the banks are able to accept, most of the banks are able to access local, the idea is whether they are deposit taking or not.
Okay, sir.
If they are not depositing in like non-banking financial companies, they are not allowed. We'll talk about one of the things. There was one doubt in PGP group. I saw that in last year's question, it was said that is NBFC allowed to access LAF facility? No. NBFCs do not take deposits. They are not allowed to use LAF facility. But there was one tool that was known as LTRO. Long-term repo operations, and then other tool was TLTRO, targeted long-term repo operations. What is that? So one is repo operations. Repo is a short-term transaction up to 365 days. But during COVID time, it was a need for the hours to inject liquidity in the system, because banking, many of those lenders, the creditors, or most of these people who had taken, borrowers were collapsing. The business was not there. They were in need of fund, in need of working capital also. They needed fund. So the RBI said that okay, we are giving them options for banks to access money from us for longer term, up to 3 years. Not expiring in 1 year. The repo operations would be accessible till, see, the money could have been taken by banks under LTRO and the money was required to be paid after 3 years. That was LTRO, long term repo operation. Repo operations, it has to be reverse also, na? How does repo operate? Once the money goes to RBI, from RBI to bank, after the expiry of repo period, repurchase period, the money is given back. And that period is below 1 year, 365 in normal circumstances. In LTRO, that time period was extended to 3 years.
Is it operating even
No,
now?
no, they have moved out of these things. That is why I have not. Then second thing was TLTRO, targeted long-term repo operations. They also fixed that if you are using money under TLTRO, then you are required to extend money to specific sectors only. So if the banks accessed money from TLTRO and the TLTRO was only for MSMEs, the banks were required to extend those funds for MSMEs only. That is TLTRO, but targeted. Condition attached for the use application of fund. Source of fund is RBI. Application of fund, specific sector. But who was accessing that fund? Banks. And in the same manner, there were certain NBFCs which were failing. They were not able to honor the expiry of, there were certain debt mutual funds, NBFCs which were failing because they were not in position of getting funds. Depositors, there is no depositors base, their debts was not, their securities were not getting subscribed. So how could they have created certain business opportunities? They went to bank and said, we want money from you. Banks denied. Sorry sir, we won't lend you because your financial position is weak. This is how NBFC works. NBFC takes money from banks and in turn they give it to other people at a higher interest rate and whatsoever is being offered by banks.
Repo rate is overnight.
Okay, sir.
No, it could be up to 365. Up to 365. Okay. So in that manner, the NBFCs were getting money from LAF. But the mediator was always a bank. Mediator was always a bank. Banks accessed it and through banks it was being used. You write another way.
They can access through banks also.
Only banks can access LAF.
Okay, sir.
In the recent times, you can write, in the recent time, banks are moving away from deposits as source of fund towards infrastructure bonds. To lend for infrastructural projects. To lend for infrastructural projects. This is because raising infrastructure bond frees banks, frees banks from parking money under SLR and CRR. Full stop. This enables banks to use 100% of the money raised for lending activities. Banks are very smart. Did you get it?
Yes.
Huh? What banks are doing now? Banks are very smart. RBI always is chasing bank. Bank is always one step ahead of RBI.
For long-term infrastructure projects.
So see what happens. Technically, what happens if any infrastructure company goes to RBI, to any bank and ask money, they are denied. because they feel that the rates that is being offered, the rates at which they are being offered, the banks would say that I would have to I will have to use my deposits, but with deposits at least 20 to 25% deposit is parked, is locked. So in a way my cost of fund is actually very high, because if I use my depositors base to fund infrastructure project, my cost, the return on investment would be less, because I need to have higher than what is required, because I need to also account for the CRR and SLR. So rather than that, I am going to capital market, I will raise infrastructure bond. I will say that the money whatsoever, if you invest in these bonds, the money would be used to fund infrastructure project. In that way, the investors would put money and 100% of the fund would be allowed for lending activities in infrastructure, and it is a win-win situation. Getting it? Because see, long-term infrastructure, they want lower interest rate. Those borrowers want lower interest rate. Banks would say, sorry sir, we are not ready to give you at lower interest, because we have commitments under, there are various regulatory norms that we are actually forced to comply with. So rather than that, we will raise infrastructure bond, use the money 100%. Okay, and this is how they come out of the regulatory ambits, because those things are 18%, 4% are NDTL, demand and time liabilities, that is not required in case of bonds. Because the moment you raise bonds, that goes outside the ambit of RBI, it is all about SEBI to look into these things. Getting it? Banks have dual commitments. They are answerable to depositors, because any lending activity which is happening using depositors' money creates moral hazard. Any lending activity which is being used through depositors' money creates moral hazard. What is moral hazard?
To pay back the interest.
What is moral hazard? Moral hazard. Exactly. See what happens. There are three parties: party A, party B, party C. This is borrower, this is bank, and this is depositor. Banks are interacting with this in lending. But if there is any risks which are created, it is being transferred to party A, although they are not involved. So any transaction between two parties creates or transfers risks to a third party, that creates moral hazard. They only gave money to party B. Keep my money safe. This was the thing. Trust that you have, bankers to your trust with us. This is the taglines of most of the bank. And this man tries to have this risky lending, and in a way this party's money is exposed to certain level of risk, because this person has defaulted. So it creates a moral hazard, and this is the likelihood scenario in case of infrastructure lending. Infrastructure projects are technically creating moral hazard, because if the project is passed, loan is sanctioned, there would be farmers' agitation. That leads to cost overruns, project delays, and who is taking the risk? The lending institution may get defaulted, and who is at risk? The depositors' money. There are only 5 lakhs which are guaranteed. So they will not be ready. But once capital market instruments are offered, suppose party A was debt holder. It bought shares of SBI infra bond. SBI infra bond. Why bond holder would buy SBI infra bond? They are only the one who is taking the risk. And higher is the risk, they will demand higher interest. There is no depositor's money which is at risk. In any capital market, it's all about the risks which has been taken between two transacting party, whose effects are not getting transferred to third party. Getting it? I was mad. I bought a share of certain company which was into illegal activity, and that company failed. That company failed. I am at zero. I was the one who, at the time of buying that share, I knew this thing beforehand that I am going into risky trading. But suppose third party is financing and third party, I would say, sorry sir, I will not pay your money because I did some risky lending and the effects would be borne by you. So that leads to lower infrastructural funding. And that is why infrastructure bond is being used as a win-win situation. The borrowers are taking money, the lenders are ready to put money, and the investors are, these are not depositors, these become investors. There's a difference between investors and depositors. Okay, got that? So this has become the go-to mean. Then open market operations, when buying and selling of securities in the secondary market. That is done in the secondary market. Specifically, bonds are sold if they want to suck excess liquidity. Bonds are bought by RBI if they want to inject liquidity. Okay, why is it done? To control the purchasing power of money, whether the currency is getting depreciated or appreciated. Liquidity. Money means liquidity. Money supply means liquidity. It is done through e-Kubed app. And the last is reserve. What a core banking solution is one of the softwares where everything is connected. Any transactions which are happening, any banks you can access funds and deposit funds to any bank without needing to have interactions with the parties. Okay, CRR and SLR. CRR we have done. So out of the net time and demand deposit or ended demand and time deposit, currently CRR is at 4%. So technically only 0.96 times or 96% is available in the market. So as CRR reduces, that much liquidity is injected in the system. Now CRR, you write this thing, CRR, it can be deposited with RBI or it can be kept with itself. It has to be in 100% cash. 100% cash. Which particular entity is required to deposit with RBI? Which are scheduled banks. Scheduled banks, they are required to deposit with RBI. Non-scheduled banks, they are required to deposit with themselves. Keep it with themselves. One more thing, scheduled banks, we'll talk about this thing in future. Scheduled banks are the ones which are listed in Schedule 2 of RBI. They can only access LAF. Non-schedules are not allowed. They need to generate sources of fund from their own ways. Depositors base or raise debts, papers, certificate of deposits or all these things. So LAF facilities, non-scheduled banks are not allowed. Okay.
So here, there is physical movement of money, sir, in this here.
What?
Is there physical movement of money, sir?
Yeah, cash is deposited. That becomes the monetary base of RBI. M0. It moves there. Because if that does not move, then in case of, they will start using the CRR also. Banks are very smart. CRR is derived from RBI Act 1934. Under this act, it is mandatory for banks to have this thing. Then comes SLR. We'll talk about this. SLR is government approved securities are also there. It could be T-bill, we'll talk about this thing. T-bills and all these things are there. That is allowed. That is allowed. This class would go to 550 because this is a very long chapter. I will just keep on skipping some of these concepts because this is very lengthy and this is the core of your prelims in economics. What?
Till what time is the class, sir?
Up to 550. Okay, this is, see, I would have just eliminated these things also, but this is important. Else everything is simple. What is CRR, what are SLR, you are knowing these things. Now one more thing, SLR becomes the way to fund fiscal deficits. Yes, Sunny, this was the actual way. If SLR quotas are not available, none of the banks would actually park their money in government bonds. So in a way, SLR funds fiscal deficits. If there is a statement that comes, SLR funds some of the fiscal deficits, this is correct.
How, sir?
How? Now you tell me how. If you know the concept, if you just apply what is SLR? Government securities are bought, and that is a mandatory exercise. How government securities are raised? That is all because of debts of the government, and because of that debts they are raising bonds. They are issuing bonds, people are subscribing to it. Suppose if the bonds are not subscribed, then it is mandatory for RBI to purchase whatsoever is floating, free floating. In a way that would become monetized deficits. Monetizing the deficit, that is not a healthy exercise because that leads to hyperinflation. See what happens, suppose 100 units of bonds were raised. Government wanted to raise fiscal deficits. To fund the fiscal deficits, they issued bonds. You are getting it now.
Yes, sir.
So they issued 100 units of bonds worth 2000 crores. Suppose. But it was found out that only 50 units of bonds were purchased. That means only 1000 crores worth of money was raised through government bonds. Then it is RBI which is forced to actually buy the remaining 50 units amounting to 100,000 crores. In a way, the RBI is actually funding the fiscal deficit. That is not a healthy exercise. That is not a healthy exercise. That is monetizing the deficits from RBI end. The highest criminal offense would be printing currency. That is the last step. So RBI is actually forced. So rather than RBI being the sole guarantor of subscribing the bonds, it is shifted to banks. It used to be one of the way to fund fiscal deficits before 1997. Before 1997, it was one of the, before 1997, policy rates was not the important thing. It was the SLR and CRR. If you go to pre-1991, the SLR rates were as high as 40%. So when you talk about the structural reforms in banking after the new economic policy 1991, one of the core mandate was reduce SLR rates to manageable limits, because higher is the SLR, lower is the money available for banking operations, basically lending operations. So this was one of the banking, one reforms was privatization, private bank licensing, other was reduce SLR, because SLR is a way just you are using depositors' money to fund fiscal deficits. This is not a healthy exercise. Then this would become a very good way to even increase fiscal deficit. This was the way, that is why at that time in 1990s, during 1980s and 1990s, we had fiscal deficit as high as 11%. Because they knew that somebody else is buying our bonds. So this was one of the conditions under the new economic policy, stabilization measures and structural reform. A structural reform was reduce the SLR rates to, so technically this would be further reduced with time to come, the financial inclusion becoming even broader, the SLR rates would go down. This is a compulsion, that is why they have moved to infrastructure bonds. Because of SLR conditions, the banks have been forced to look at other ways to source the funds. Getting it? Getting it now? Okay. And this is under the Banking Regulation Act 1949. Okay. Yes, this is under Banking Regulation Act. CRR is under RBI Act, because CRR talks about the liabilities of RBI also, na? CRR is the liability of RBI, but not this SLR. SLR, the liability is all for the government to make sure that they honor the bonds. RBI is only issuing on behalf of government. Okay, but in case of SLR, the money does not move, rather the money gets locked in the government securities. It remains with the banks and they earn interest. On CRR, they do not earn interest. On SLR, they earn interest.
Buying government securities is mandatory for all the banks.
No, you didn't get. If I give you the condition that you need to have higher SLR, and under SLR you are required to buy government securities, you are forced to buy government securities, na? All because your deposit base is increasing. That money is being used to fund fiscal deficits. There are other securities. It could be gold, it could be bills, treasury bills and government securities, it could be state development loans, SDLs, if the same bonds are issued by state governments. It could be other approved securities like securities of public sector banks, public sector undertakings, and also certain corporate debentures, like debentures of big AA, AAA rated companies. Okay, it is not government securities, it is government approved securities. Got that? So basically this is what has been written. CRR, percentage of bank's total deposit, liquid cash with RBI or with itself also, if it is non-scheduled. Bank cannot use this cash and does not earn interest. It is only a tool to control the money multiplier. Statutory liquid ratio, currently it is 18%. It could be government approved securities, it could be government securities, state development loans, it could be corporate debentures which are approved. Okay, and the interest is earned by banks. This is not used for repo operations. One more thing, this is not used for repo. For repo operation you need to have over and above what is available. Up to 2% that is allowed under MSF.
So not used in the repo, sir, this thing.
This is not used in repo. This is in anything which is kept as a reserve. You are not allowed to use this for any operations.
Okay, sir.
Now in case of controlling inflation, it is very easy. Obviously, if you need to control inflation, basically you are reducing money supply, increase everything. Or in case of OMO, you sell the government securities, it absorbs liquidity. Opposite is if there is lower inflation or you are supporting growth. Now there is another concept that is known as monetary policy transmission. Monetary policy transmission. What is it?
Passing on the repo.
Exactly. How the monetary policy decisions are passed to the markets, end consumers. If there is cut in repo rates, whether the lending rates are also cut, or if it is increase in repo rates, whether the lending rates have increased or not. So there are two important ways this is controlled. One is MCLR, another is EBLR. One is MCLR, marginal cost of fund lending rate. So under this MCLR, it is the rate, basically it is the rate which ensures the bank should maintain, they should come out what is the cost of sourcing those funds. It discounts for the repo rates, the prevailing repo rates, it includes repo rates, what is the CRR and SLR levels which are being debited, what is the operational costs, and also what is the tenure for which this has been done. Higher is the tenure, they have higher MCLR. Repo cost, repo rate cost first, second is CRR and SLR, because higher is the CRR and SLR, even if the lower is the repo rate, they would have more money parked which is unused. Third is what is the cost, operational cost, cost of employments and all these things. And fourth, what is the tenure for which this is being raised. And they are not allowed to actually lend below MCLR. One is this, if repo rates increases, the cost of fund increases for them, and that is why the monetary policy transmission in that way would be higher cost of loan for the banks, for the consumers. But it has been found out why. Then second is external benchmark lending rate. It was found out that once repo rates are increased, bank increase the lending rates. But once repo rates are reduced, bank reduce the deposit rates. Got this? Did you get it? Once repo rate is increased, bank increase the lending rates. Ideally deposit rate should also increase, lending rate should also increase. But they do not increase the deposit rate, they increase the lending rate. Once repo rate is cut, they do not reduce the lending rate, they cut the deposit rate. Why? To increase the margins. To increase the margins. That leads to delay in monetary policy transmission, because they wait whether the demand is going down. Once the demand is going down, they will cut the lending rate. So in that way, that creates a lag. Getting it. Ultimately, banks are also profit making machines. They want to increase the profits. Technically, policy rates, are you getting it? So second, which was created, so they have moved, RBI said that all those loans would be actually classified based on EBLR, external benchmark lending rates. So there is one financial benchmark institution limited banking something, FBIL, that is, I'm not knowing the exact full form, financial benchmark something lending, some companies there, which brings out the rates which is considered to be the benchmarks. Those benchmarks could be first the repo rate itself. So the loans would be written as, the home loan is at 2% over repo rates. So as repo rate moves up, the loan rates would move up. As repo rate moves down, the lending rates would move out. That is how it is benchmarked. It could be T-bills. Okay, and of late there is one more that is becoming famous, that is MIBOR, which is becoming famous, that is MIBOR, Mumbai Interbank Overnight Lending Rate, MIBOR. It has been derived from LIBOR. MIBOR pe aa gaya. So that is external. So did you get it? What is the purpose? Monetary transmission, policy transmission should be quick. Now everything is, now if it is linked with external benchmark, if repo increase, lending rates increase. If repo goes down, lending rates go down. And this is what they say as spread. It is written as spread. Okay. Spread is what is the rate at which loans are offered over and above the benchmark rates. Obviously, they won't offer below benchmark rates. This is known as EBLR, and this is known as monetary policy transmission. Got that?
Sir, please repeat the spread again.
What?
Spread.
Spread is whatsoever is over and above the banks are charging over and above the benchmark rates. Benchmark could be MIBOR, it could be the repos. Most of the banks use this, repos or MIBOR.
It is higher than the repo rate, sir.
Obviously, loans would always be higher than repo rates.
Okay, sir.
Okay, one more thing you just write, spread is also known as interest margin for banks. Spread is also known as interest. So spread could be, there are various things. Spread is a general term. For external benchmark lending rate, it is what is over and above the external benchmark rate. Spread could be a general term, that is the difference between interest charged on loans and interest paid on deposits. That is also known as spread.
What is the rationale behind this, sir? I mean, the spread. Is it kind of legally allowed?
Legally, this is actually mandated by RBI.
The reason behind it, sir, for the banks to profit make or something like that.
No, the idea was, see, RBI cannot control the lending rates in the market. They can only tweak the policy rates. But it is up to banks how they are charging, how they are passing on the rates. So it was found out that if any rate is cut, it is technically deposit rates which are generally cut, rather than technically the intentions of RBI was to make sure that the lending rates are cut, but the banks are they play wait and watch game. They say that okay, if the repo rates have gone down under MCLR, they did not used to actually pass on that monetary policy transmission. They would say they will not reduce the lending rates. That is depending upon the demand and supply of loans. Even though it is costly, but still they are higher because the demand is very high. The transmission was not happening at a smoother rate, so the banks were actually authorized that if any further fresh loans are actually raised on floating basis, it should be based on EBLR. Now it becomes very easy for RBI to control the lending rates just by changing repo rates. Got that?
Yes, sir.
Okay.
Not to the bank.
Basically, they want to negate whatsoever tactics that the banks are playing, they want to negate it. That is the idea.
Even then, they cannot control the banks directly, sir.
No. We'll talk about qualitative tools are there, but still, you cannot control the demand and supply. That is a free market system, na? If people are ready to pay you higher interest rate, let them pay higher interest rate. But that is, all in all, long term, it's a loss for the economy. So there are qualitative tools also. These qualitative tools are, first is margin requirement, that is also known as loan to value ratio. Basically, this is value of collateral and loan amount offered. It is given as a percentage. If LTV increases from 60, suppose this is 60%, that means for every 100 rupees value of collateral that you offer to the bank would give loans worth rupees 60. If LTV increases, there would be more demand for lending. More money would be unlocked. Money would be unlocked. Okay? Because for the same collateral, more loans can be offered in the market. Second is moral persuasion. Basically, banks try to invoke the developmental roles and all these things of the other. RBI invokes these things that you have also these roles. You should go and operate branches in rural areas also, even at the cost of profitability, because it is very unprofitable, highly unprofitable to open branches in rural areas. The cost of operations are similar, but the revenues are less. But still they are actually nudged to do these things. That is moral persuasion. Credit rationing, how much credit for different sectors. Which sectors can be extended to what credit, what should be the maximum level of credit. At the same time, how much amount which a bank can extend as a loan to a single borrower. That is also credit rationing. That if suppose there is one bank which has extended all the loans to the portfolios of Adani company, and once Adani is off, the bank is also off, because that has been coupled, it has been primed with whatsoever is the performance of Adani. If Adani is doing good, the bank is doing good. If Adani is doing bad, bank is gone. That is also credit rationing. The portfolio should be having a mix of your borrowers base rather than only single. They could have many other companies also. In a way, you are taking a risk. And third, last is consumer credit regulation. That is EMIs, payment terms. How much amount of EMI is allowed for a particular salary? Currently, it is 45 to 50%, not more. Even if you have taken multiple loans, total EMI should not exceed more than 40% or 50% of your net take-home salary. That is why credit score is important. They check all these things. Else, what would happen? You are living on credit. You are taking credit to pay last credit. Okay, so this is consumer credit regulation. Also, what is the duration of loan? For a vehicle loan, it is only 5 years, 3 years, 7 years. For a home loan, it is higher is the payment period, lower is the EMI, and that is controlled through consumer credit regulations. They are not using any tools like money supply being changed through any rates. They are changing through norms, regulations. Okay. Now these are the tools or policy stances. If RBI says that first they will come out with the policy, this year's policy, this particular meeting's policy, and they will say what would be their movement in many other policies to come. If that is hawkish, that means they will keep on increasing rates. They will increase rates quickly. So one question is, why don't they increase instantly? Why don't they increase? Exactly. The idea is one way they would say that they increase it by 50 basis point and again they increase by 50 basis 0.5%. Why don't they increase it say 2% instantly? That is data driven first. Second, it will lead to certain shock in the market. The EMIs and all these things would increase tremendously, and that would risk the market. Rather than this, they take a decision and they talk about the stances, about the future expectations. That is hawkish. They will keep on increasing it. Calibrated tightening, they will either hold it or would increase it. After hawkish, they move to calibrated tightening. Either they will increase it or they will hold it. Okay. Accommodative, if the economy is not doing good on the growth front, growth with price stability, these are the two mandates. On the growth front, if the economy is not doing good, they will try to have lower interest, lower policy rate even if the inflation is high, just to support growth. That is known as accommodative. Technically, they should have countered inflation, but rather than countering inflation, they are saying that they will hold on the rates just to help economy grow. Okay. Then withdrawal of accommodation. Withdrawal of accommodation means now this is not done, all holding is done. Either we will hold or we will make sure that in future there could be certain rate increase, but that would not be as higher as calibrated tightening. Calibrated tightening means they would increase to control inflation, but here it is more about growth which is more important. Okay. Here the focus is on inflation. In these the focus is on growth. And in neutral, they are not saying anything for the future course of action. They are neutral. They will take decision depending upon the information from the market. If the prices are increasing, they will increase it. If the prices are reducing, they will reduce it. Current stance is neutral. Current monetary policy stance is neutral. They will wait for the data to come from the market. Dovish, it is not used. They will reduce the interest rates drastically. That has not been used in Indian context. It is technically used in developed economies. When the growth is in negative territory, they need to reduce the interest rates also. That is dovish stance. Okay. No, minutes, minutes. They come out with the minutes. Stance is written. The minutes has specifically, it mentions the stance of the committee. Now, we have talked about these things. There are three important systems in India. One is commercial bank, cooperative bank, and all India financial institutions or developmental financial institutions, DFIs. Commercial banks are those banks which are listed in second schedule of RBI Act. It includes public sector banks, private banks, and foreign banks. These are the important things. You are required just to listen these things. It is not so.
So what is scheduled commercial bank and scheduled bank, both are same?
Same. No, what I am saying, scheduled banks could be scheduled cooperatives also. Scheduled banks are those banks which are listed in Schedule 2 of RBI. Scheduled commercial banks are only important banks which are having no restrictions in whatsoever the type of customers which they are catering to. Cooperatives banks could be scheduled banks also, but they are only catering to the way cooperative banks are run. Scheduled cooperative banks and scheduled commercial banks. Scheduled commercial banks could be these banks. Okay. Non-scheduled banks are also. What? Second schedule is a specific schedule to the RBI Act, because an act cannot have all the details. Schedules are there just to complement the detailed information. That is also there in case of India's constitution also. Schedules are always there. Okay. Schedules can change, but the act does not mean that the act has changed. So these are the public sector banks. SBI through SBI Act 1955. Other nationalized bank, these are known as public sector banks. Public sector banks. That is why, although SBI is also considered as public sector banks, they will write categorically as SBI and other PSBs. Because the acts which is governing is this, there are two sets of act. One act was passed in Bank Nationalization Act in 1969, other in 1980. Once they were a private bank, they have been converted into nationalized banks. 14 and 6. And they again further they have been amalgamated into many other things. There have been further amalgamations. Okay. Regional rural banks through Act of 1976, RRB Act 1976. RRB Act 1976, Khusro Committee. They came out with this particular RRB. The function was, none of those nationalized banks or public sector banks were ready to actually cater to the needs of rural economy. And this year's budget has talked about rural credit score. Have you heard about this?
Yes.
Heard about this thing? No? So how a credit score works up to from 300 to 900, that is the criteria. The credit score, the credit worthiness of an urban consumer is different from those of rural consumers. So this year's budget has talked about that a separate credit score would be brought out for rural consumers. Rural credit score. Because the dynamics are different in rural economy. Okay. So obviously these are the banks, these are full licensed banks. Full licensed banks. Differentiated banks are known as niche banks. Niche banks, basically they cater to specific classes of customers. Here we have two specific things. One is payment banks, another is, what is that? Small finance banks.
Sir, what meaning of full licensed?
Full license, they are allowed to do all sorts of banking operational activities. There is no restriction on the class of customers which they will cater. But in case of differentiated banks, there are certain restrictions. Like in payments bank, they are not allowed to go for lending activities.
Yes, all private bank or ICICI.
Everybody, these are all universal. Even the public sector banks are universal banks. All. Foreign banks are also there. And one more thing, there are more foreign banks than public sector banks in India. Even combined, there are public sector banks, private sector banks and foreign banks. There are more foreign banks than private sector and public sector banks combined.
So example of foreign banks? Yes.
HSBC, Barclays, Citibank. So there are more, 43 or 42 foreign banks are there in India, and combined public sector and private banks, it is hardly 35, 36. 12, 13 PSBs are there, 11, 12 PSBs and 20, 22 private banks. I am talking about domestic private banks. Foreign banks, there are I guess 42, 43 foreign banks. There are Bank of China, Bank of Iran, there are many banks. I am not talking about number of bank branches, number of banks which are operating in India. It could have only 1 or 2 branches, does not matter. Okay. So there are certain restrictions. So all the banks which are operating in India needs to comply with the regulatory framework of CRR and SLR. CRR and SLR. CRR and SLR are not imposed on non-banking financial companies. Although RBI wanted to impose, but that has been taken back. They wanted to impose NBFs. They wanted to extend this CRR and SLR for NBFCs also. Foreign banks are also, if they are operating in India, they need to comply with the directives of RBI. I am talking about those branches which are operating in India. It does not mean the HSBC bank which is operating in Shanghai has to comply with India's rules. If there is a branch of a foreign bank which is operating in India, they need to comply with RBI directives, specifically adhering to CRR and SLR. And CRR and SLR also are applicable on differentiated banks as well, foreign banks as well, universal banks as well.
If our bank is operating in international,
They need to comply with that there. Obviously. Obviously, 100%.
LF is for all the banks, but CR and SLR, they are not for NBFCs.
NBFC is not there.
LF to NBFC के लिए भी
नहीं है. CRR and SLRs are also not applicable for NBFCs.
The
They-
complete LF is not applicable.
LAF, they cannot access fund from LAF, NBFCs. Although banks can give them funds by borrowing from NBFs, from LAF, but that would be bank acting like an intermediary. They cannot directly say, since they do not have direction, they do not have deposits now. They have not parked their deposits with RBI. How can they access? They are not deposit taking. Some of those NBFCs are there, don't go deep into these things. Some of these NBFCs are deposit taking, but that is hardly 1 or 2. No, FinServ is also not deposit. I'll get out a list of all these things. I guess there are 1 or 2. So cooperative banks, they are having dual regulations. One is central as well as state. They are basically cooperative financial institutions. Cooperative financial institutions. So the cooperative banking system in India is, if we talk about cooperative banking, it has, one is urban, other is rural. Urban is urban cooperative bank. Earlier They are registered with Registrar of Credit Societies, RCS. They are registered with Registrar of Credit Societies and registered under specific state acts. But because of higher deposit base in urban cooperative banks, there were certain banking laws amendments which were done, and urban cooperative banks were brought under the folds of RBI as like a universal bank, universal private bank. Urban cooperative banks also operate in the same manner. So all those directives which are there, RBI can also come out with for certain directives for urban cooperative banks. Earlier there were dual regulations. But in case of rural cooperative banks, there are two again terms. The one is short term, other is obviously long term. Under short term there are three tiers. What are those three tiers? Your state, district, central cooperative. Don't say central, they write as central, but that is district central cooperative. Technically, if you think state is at top, how can central be at the second tier? State cooperative banks operate at state level, central cooperative banks operate at district level, and last one is PACs. District central cooperative banks are known as central cooperative banks. That is what I mean, but that they operate at district level. What?
Why is it called, are they under control of center, sir?
No. That is how that is. That the name itself is like that, because we'll talk about in long term. We have state cooperative agriculture and rural development bank and primary agriculture cooperative and rural development bank. It is clumsy.
So, जो primary agriculture credit society जो है वो बैंक किस लेवल में work करती है?
At the rural village level, block levels and village level. PACs, I would say PACs, how would I say, there are many. Regional names are there.
The local demand.
See, at the local level, village politics and village panchayat levels, they work at PACs. That is why there are various elections to PACs. PACs level elections are there. And one more thing. Urban cooperative bank, up to these state cooperative, district central cooperative, and all these state cooperative agriculture rural and primary agriculture rural, all are required to comply with CRR and SLR, but PACs are not required technically. They are regulated, but they are not mandated. Because if their money is locked, the idea is, if their fund is locked, then what is the purpose of PACs?
Credit society.
They are credit societies. Then if you are actually slapping them with certain regulatory frameworks, then they will say, sir, we are actually locked with 30% of our fund is locked. And that is why there is higher level of corruptions in PACs. They are actually outside the regulatory ambit of RBI. RBI says that if you want us to be having a regulatory oversight, impose those CRR and SLR. In future, it may so happen that is imposed. See, urban cooperative banks were also not imposed, but the deposit base grew to 3.5 lakh crores. And in the meantime, in 2018-2019, we had all lots of many Shivalik Mercantile Cooperative Bank, Punjab and Maharashtra Cooperative Bank. There were many defaults, and many suicides were there from depositors. These fools, they deposited their whole money, deposit their whole pensionable, all their money, what lifetime savings, just to earn extra interest. They offer obviously extra interest, 1 or 2% extra. And it failed because there are certain collusion. Recently, Capital Cooperative Bank, it has been found out that the money was siphoned to the tune of rupees 18 crores. The fund was actually given to some of the Bollywood stars. Cooperative banks, that members are the owners, and they are the only ones who are the depositors, and they are the only ones who are the borrowers. They cannot give loans to outside. So you first need to become the member of cooperative bank. So what happens if you become a member of cooperative bank? You siphon off higher money. because the level of scrutiny is less. Got that? See, you can always be a supervisor, and supervise obviously those who are working, those who are actually committing these financial crimes, they are always smart. So these are developmental financial institutions. First is NABARD for agri and rural finance. NABARD is a refinancing agency. NABARD is also the rural sector regulator. Any rural financing which is happening, like PSL, priority sector lending, rural credit, SHG, MFIs, NABARD has all the authority to check the books. So all these agencies have one to comply with the regulatory norms of RBI, and also supervisory norms flows from NABARD. They are not direct banks, they are refinancing agencies. They give money to these microfinance institutions or banks, and in return banks extend loans under various agricultural credit programs and all those rural credit. Those farmers and customers do not have direct banking or direct bank account with NABARD. This is known as refinancing. They do not have direct accounts. They extend loans via intermediaries. Okay. Second is SIDB. The same thing if it is for MSMEs. They support MSMEs financing. Technically, Mudra is a Mudra, Pradhan Mantri Mudra Yojana has been created through Mudra Bank, and Mudra Bank works as a subsidiary of SIDB. Mudra Bank works as a subsidiary of SIDB, Small Industry Development Bank of India. It supports development of small industries, and small industry, you know this, it is also referred as, in India it has been Mittelstand. Economic survey refers small industries as Mittelstand. What is that Mittelstand? This is a place in Germany. Germany has a very prominent small industry ecosystem. So that is why India also wants to leverage that thing, because it has higher propensity to create jobs rather than large corporates. At the same time, small industries or small MSMEs are also present in regional areas, and that leads to regional development rather than regional concentrated development. Large corporates are already available in few pockets, but MSMEs are available in many other areas, and they create many jobs, and they get support from SIDB. Export import, it provides trade credits. What is trade credits? Exactly what happens, if there is any exports from India, the importer would not settle the amount instantly. They will not settle it instantly. They will say that once your product is received, we will check, and once we will get those money, we will settle your money. In the meantime, those exporters would be in need of working capital to go for business for the second round. It will take say 3 or 4 months to get the money. So they get access of fund from Exim Bank. In the same manner, if the importers in China wants to have imports from India, Exim Bank would also support those importers. You get the support?
Directly, sir.
What?
Can they lend directly?
To the importers and exporters directly. Approved importers and exporters, not anyone. They need to have good credit worthiness. Obviously, because cross-border transactions are there, there needs to be an intermediary to have that information. To support the export and import, NHB, it supports housing finance companies. What are housing finance companies? DHFL loans, India Bulls, LIC housing finance, PNB housing finance. Any financing company, any NBFCs whose portfolio has more than 50%, I guess 50 or 60% portfolio into housing financing is considered as housing financing companies.
They give home loans.
Home loans. They are technically NBFCs, non-banking financial companies. Non-banking financial companies. Then last is NAVFID, this is the most recent AIFI to support infrastructure development. Housing finance companies, I would say, housing finance companies are those, NHB is a regulator of housing finance companies, and housing finance companies are those NBFCs whose portfolio has majority of those portfolios should come from housing loans. Suppose if this PNB, there is PNB Bank, Punjab National Bank, there is PNB Housing Finance Company, and PNB Housing Finance Company should have at any time majority of their portfolio should be invested in or should be catering to the loans demand from housing. They should support housing loans. Okay, that is the idea behind. And NAVFID supports infrastructural development. Then comes NBFCs. NBFCs are all those financial institutions which are not banks. They go about lending, they go about investing, they go about insurance selling. All these activities are there. They are into transaction and trading of commercial and financial products, but still they do not take deposits. So that is why they are not allowed to have direct liquidity, this LAF facility with the RBI. They cannot access funds from LAF window. Okay. And since they are having different ways, financial products, there are various regulators. If they are into gold loans, Manappuram gold loans and all these things, they are regulated by RBI. If they are into investments, selling mutual funds and all these things, they are regulated by SEBI. And if they are selling insurance products, ULIP, if you have heard about ULIP, unit linked insurance products and all these things, they are regulated by IRDAI. Insurance Regulatory Development Authority, Regulatory Development Authority of India. Okay, so they are regulated depending upon the area where they are catering to.
Their regulatory norms will be
Different, obviously different. If that is lending, deposits, RBI would have certain things.
And that would be same for all the NBFCs.
No, that is what, there were various tiers that was brought out. They have talked about that NBFCs which are catering to lending and deposits, lending activities. There is a talk that they have been categorized into various tiers. Don't go into these things, please. That would become too much financial. If the portfolio size is 10,000 crores to 2,000, there are 4 tiers that has been created in NBFCs. Tiered structure for NBFC, and for top tier, they wanted to ensure that as CRR and SLR also, that their investment, even if they have raised money through various sources, the money should be invested in certain government securities or should be given as cash. But that was, this was paused, that particular policy was paused, it has not been implemented. Else that would become very difficult, very restricted for NBFCs. Already they are not accessing money through LAF. They are not accessing money from they are taking money from banks, and RBI is saying that you put some of those money to CRR and SLR. Already that would become too much restrictive for. But still RBI wants, because there have been certain issues, like there have been many scams under NBFCs. Okay. So Basel norms, the regulatory and prudential norms, it has been created under this framework, banking supervision framework, this BCBS framework, which was under Basel framework. It is known as Basel framework. Till now 3 frameworks have been created. Current compliance is under Basel 3. It talks about some of those ratios which ensures the health of banking system. Which ensures the health of banking system. So the first is CRAR. This is also known as CAR. In local terms, this is known as capital adequacy ratio, that is capital to risk weighted asset ratio, CRAR. The idea is the bank should have their core capital, their own money should be parked in a different account so as to cover for certain risks in case they are going for risky lending. It ensures the health of the bank. Suppose they are going into, say, risky lending like unsecured credit card lending, buy now, pay later. These are risky lending. So for that they increase the risk. If the risks are increased, so this is all about bank capital and risk weighted assets. Weighted assets means whatsoever is the weights which are there. Weighted means weighted assets. If the risks are increasing, if they are venturing into more risky lending like credit card, personal loan, buy now, pay later, these are risky lending. These are unsecured in nature. So if this portfolio increases, the base would increase. This risk weighted, any loan is an asset for the bank. And if your risky assets are increasing, this ratio this denominator would increase. Obviously, to maintain that particular CRAR level, you need to increase the bank capital also. So CRAR, Basel 3 prescribes 9%. But India's bank hold 12% and 15%. Currently it is 15.5-16% which the banks are holding. So banks are actually ready to forego these much amount for extended lending activities just to maintain the health of the financial institutions. If you are maintaining over and above that is required, what you are doing? You are actually foregoing that money which could have been used for other activities just to maintain the health of the financial system. So currently it is 15.5-16%. That means RBI prescribes 12% and 15%. For a small finance bank that is 15%, for public sector bank that is 12%, that is like that. Okay, but they are maintaining up to 16%, 15.5 to 16%. Okay. Don't go into deep what is core and high quality capital, what is, and from there was one term which was known as AT1 bond. Additional tier 1 bond. Have you heard about this? Yes Bank saga and all these things. Additional SBI also had issued as additional tier 1. So what happens if your tier 1 capital is not so high? You can float additional tier 1 bond. Those bonds are issued in the name to just supplement tier 1 capital. But that is highest, that is riskiest. The bank does not guarantee that these are perpetual bond. Perpetual means the bank would not return you the capital amount, the principal amount. Bank would pay you interest till eternity, till infinite times. But once Yes Bank flopped, those 80 and 81 bonds were scrapped and the investors were at risk, at loss basically. See, you know that this is tier 1 capital plus tier 2 capital. Tier 1 capital is core and high liquid, basically your own shares, your own money which you have brought in. If you do not have own money, you raise additional tier 1 bond, that is 81 bond. 81 bond just to increase tier 1 capital. But that is perpetual in nature, you are not required to pay back the principal amount. Getting it? That is the riskiest form of investment. That guarantees you 10-12% till lifetime. Obviously you are taking the risk. Second is capital conservation buffer. That is 2% over and above the minimum capital requirement. That means if it is 12% for public sector banks, they are required to maintain 14.5, wherein 12% would be considered as CRAR and 2.5% would be known as capital conservation, that would be used in case of any issue, risks. That is known as capital conservation buffer. And the third is liquidity coverage ratio. So the banks are mandated to hold high quality liquid assets, basically cash or cash equivalents. Cash or cash equivalent, that means any investments which can be liquidated in the earliest possible times, like T-bills. T-bills. So how much amount of cash? that should be able to fund 30 days stress scenario. What is stress scenario? That means for the past 12 months, whichever month saw highest outflow of money, highest redemption of whatsoever deposit, you need to maintain that much amount of cash in separate account, so that bank run does not happen. Getting it? There could be
Separate from
CRAR is different, LCR is different. They need to just set aside this much amount.
Overall, then the banks are setting like 25 to 30% of.
Oh, that is why they are moving to infrastructure bond. Now, that is what they are moving. Banks are saying that our cost of funds are more than what we are getting, because we need to set aside CRR, SLR, these are mandate things. Okay. But CRAR is something different. CRAR is based on risk weighted asset. Risk weighted asset means if the loan is portfolio is in home loan, the risk values are 0.5 or 0.3, because that is secured assets. So what if you have 1000 crore parked in home loan, that would be considered as 300 crores only, because that has a risk weight of 0.3, and based on that capital is calculated. Don't go deep, that is different. Okay. Non-performing assets, simple. If there is no payments which is coming either in interest or in principal, for 3 months, that is logged, 90 days, the account is transferred into NPA account. Before that, they are mentioned in 3 separate accounts, that is SMA 0, SMA 1 and SMA 2. Loan, principal or interest, anything that should come. It's not just the principal amount that should be paid, it should be anything. If that is, the bank is not receiving from any asset, that becomes NPA, and if that is NPA, there has to be higher provisioning. That means there is a risk of default. The bank should set aside some portion of profits from their own profit, they should set aside to cover for the risk. Higher the chance of NPA going into loss account, 100% provisioning is done then. There are three levels. So if NPA is settled in gross values, that is known as gross NPA. And if you just reduce the provisioning amount, that becomes the net NPA. The gross NPA has been moving down from India. It peaked at 11%. In 2016-17, it has moved down to 2.5%. At the same time, net NPA is below 1%. Net NPA is below 1%. So these are the basic idea. If that is NPA for loss asset, if it is loss asset, it goes into recovery. It goes into recovery, and technically write-offs are there. Write-offs are there. The asset is set aside, moved away from the balance sheet, so that further provisioning is not done. But that does not mean the money would not be pursued for recovery. If there is any recovery in future, that would go into insolvency, bankruptcy. There are various means. Earlier it used to be SARFAESI Act. Now it has been subsumed under IBC 2016. So they go into IBC and all these things, and they recover money. Okay. So that is all about write-offs. See, this is very long chapter. So that is the idea behind write-offs. If the accounting, it is an accounting exercise. If the bank has assets and liabilities, asset means the loans, and if the loans are becoming non-performing, the bank has to increase provisioning cost, and if it keeps on lingering, they will have to keep on adding provisioning cost. It is moved away from loan. Lower assets, lower liabilities, the balance sheet values goes down. At the same time, it does not mean that the recovery would be pursued. If in future any recovery that is done, that would be written as profits from other sources. Suppose they will incur losses this year, suppose after 3-4 years there was certain recovery, and they would declare that as profits from other sources. Okay. And if it is a waiver, there is no pursual. Basically the money is not pursued. It is done. It is given as a gift. It's a tax expenditure. It is generally done by the government, not by the banks. Banks do not go for waivers. They won't go for waivers. Now comes your questions. We'll deal some of the questions. This was a very long. Oh, so this is how they keep on asking. This is very simple. See, they ask simple question. In only 3-4 question, they will have certain tricks where your basic knowledge and your gut feeling is tested. This was one of the PYQ, I guess. This.
First is wrong. Only
It was initiated by NABARD. And SBI is the agency bank. Oh yeah, this is incorrect. SHG, all members of a group are taking the responsibility. This is correct. This is correct. And only 2. Then we have now this is, you need to apply your brain. Although this should have come in external market, but still it is very difficult. I told you, if the inflation is too high, RBI is likely to buy government bonds. RBI would be a fool then. Would sell because they need to absorb excess liquidity. Okay. So there is a term that is known as sterilization. What is sterilization then?
2 and 3 and only 2.
If the RBI, rupee is rapidly depreciating, RBI is likely to sell dollars in the market. Oh, sorry, this is correct. This is correct. Second is correct. Second is correct. Yeah.
Sir, second is right.
Oh, sorry. Second is right. If the interest rates in US or EU were to fall, that is likely to induce RBI to buy dollars. Is it correct? Exactly. Interest rate, there would be interest rate differentials. If rates, why currently dollar is becoming stronger? Because interest rates in US is higher. So that is why US dollar is becoming stronger, and if there is lower interest rate, the money would come to India because it would be beneficial for those foreign investors to invest in Indian currency. We'll talk. No. What happens if there is interest rate differentials? If the FD rates in US banks and FD rates in Indian bank, if FD rates in Indian bank is higher than FD rates in US bank, those foreign investors would say, come to India. And they will come with dollars. So when they come with dollars, RBI would start buying dollars. If the FD rates in US banks would be higher, they will say that it is beneficial to invest in US companies because the risk to reward ratio is favorable in US or Europe. They will sell US dollars and they will buy the US banks. US, they got it. What I am saying, if the rates in US and US to fall, then they will come to India and invest in Indian banks. Then RBI would start buying dollars. 2 levels. There are 2 levels of things getting operated. Getting it?
Yes.
So 2 statements are correct, na? C. If this was decreased, then this would have been correct, else C is the correct answer. If CRR decreases, then money multiplier increases. If CRR increases, money multiplier decreases. Actually, money multiplier is nothing but increase in banking habits.
Sir,
A. A. Tight monetary policy means the hawkish stance. Okay. Loose means dovish stance. Or it could be accommodative also. Expansionary monetary policy, it can result in a decrease in bond. This is very good question. We will have this effect. We will talk this thing in capital market also, but first apply your brain. What?
All three.
2 and 3 is there. What about first? 2 and 3 is correct. Obviously, the cost of lending would decrease. More money would be used for. First is
इंक्रीज होगा तब सर सही है फर्स्ट तो ये क्योंकि इनवर्सली प्रोपोर्शनल बॉन्ड यील्ड का होगा इंटरेस्ट रेट तो जब इंटरेस्ट रेट कम होंगे तो बॉन्ड प्राइस बढ़ेगा.
that is what you have self-explained. If
Yield will increase,
yield with
Yes, yes.
not yield, bond prices would see yield and interest rates are aligned together. If interest rates are going down, that would mean it is beneficial to now buy long-term investments. In the meantime, what does signify? That people are selling their FDs and moving their money towards bonds. Basically, they are buying bonds, and if there is higher demand of bonds, the bond prices would increase. So, the bond prices is inversely proportional to yield, and 1 upon yield, but yield is directly proportional to interest rates. In a way, bond prices are inversely proportional to interest rates. Why does this happen? See, if it is beneficial, if it is attractive, the yields are attractive, they will start buying bonds and technically the yield would drop. And that is why interest rates and yield are managed. And that is why the operational twists are done from RBI, selling and buying of long-term and short-term securities. If they want to have lower long-term yield rates, they will start buying long-term the RBI would start buying long-term securities. So that it would give the signal to government, now you can raise long-term bonds at a lower yield. Talk about that, we'll talk about, got it? This is how they will buy that thing and sell the short-term securities. Okay. Done. Third, this is also correct. If it is incorrect, you just change this to correct. Oh, sorry, this is incorrect. Sorry, this is incorrect. This is incorrect. This is incorrect. B is the correct answer. It would increase bond prices. Increase bond prices. With reference to the legal definition, narrow money and broad money in India, consider the following statements. Third is wrong. First is wrong. First is incorrect because small saving schemes are part of broad M4. Other or total deposits. Okay. This is M4. It is broad money. An increase in number of bank accounts can increase the base of broad money, obviously. The depositors' base would increase. And third, if there is withdrawal of cash, what would happen? Cash with public would increase, but the deposit in the banks would.
Circulation. Withdrawal of 2000 from circulation itself. तो वहाँ पे तो
Okay. From circulation may have no effect on the base of narrow.
it will have effect.
No. This is correct. It will change the M0, not the M1. Because what happens if you withdraw circulation, the same money would get credited in your savings account.
Yes, sir.
I'm just telling you one thing.
Value तो same ही रहेगी ना.
If there was demonetization, did it mean that the people did not get likewise credit in their savings account? They got that much credit in their savings account. You deposited your older currency. The currency was withdrawn and the same amount was credited in your savings account. It would change the M0, not M1. Getting it?
But it can be used for, sir.
What?
Okay, we say it's going to savings account only, sir.
What? Please repeat again.
Sir, can be used on some.
No, just I am giving you an example. This example, just take an example of demonetization. 2000 rupees currency, suppose in future 2000 rupees currency is withdrawn. It has been withdrawn from circulation. Has it changed narrow money? No, because the same thing gets credited in your savings account.
4-5 हो गए.
Either it would get exchanged into different denomination, or you will say that I am giving. There was certain window, na. You deposit your 2000 rupees, and the same money would get reflected in your savings account. It won't change the base, or it won't change the M1 base. It will change M0 base, but it will not change M1 base. Any issue you can ask me again if you have any issue.
But M0 भी कैसे change होगा?
Third statement.
The currency in circulation may go down.
200 को अगर निकाल के क्रेडिट भी दे दिया अगर बैंक ने तो
M0 is currency in circulation. Currency in circulation means the money has been withdrawn. M0 may change. M0 may change because currency in total circulation. I am not saying that taking 2000 rupees you are given 500 rupees note. I am saying that the thing is withdrawn and the same amount was credited in your account. It will change the monetary base.
Because M0 is liability.
RBI's liability would go down, na?
ये प्रिंट नहीं हुई.
नहीं print हुई. That you also got that M0 would change. It may change, it may not change, but it is most likely to change. The liabilities of RBI would go down because the currency in circulation would go down. Here the premise of this thinking is the similar amount of currency has not been issued in different denomination. Getting it? But in any case M1 will not change. Either you will get exchanged notes or you will get likewise credit in your bank account, in your savings account. Okay. At times what happens, I also get confused because how you are thinking, your premise defines how you will approach the answer. This. Obviously, if there is higher loan to value ratio, it means more loans are offered and it is a way to tackle recession in the economy. Here the premise is the loan is not taken for consumptive purposes, it is being used for productive purposes. The loan is not being taken for buy now pay later, purchasing things from Myntra. Even if you are purchasing things from Myntra, consumption expenditure would increase. That would most likely increase GDP. All three, these are small savings instruments. Some of them are issued with the government, some with the post offices. Okay. So Kanya Samriddhi is with the government. PPF is also with the government. Post office savings account is with the post offices. When the RBI buys government securities, it can increase borrowing costs in the market. It can decrease because it injects liquidity in the system. As the liquidity increases, there are more funds with the banks and the interest rate is most likely to go down. That does not mean it will go down. That is dependent upon the monetary policy transmission, how the banks are approaching things. Most likely. When the RBI sells government securities, it can depreciate rupees. No, it can appreciate rupees. Appreciate rupees. Okay. How many of the following are the likely effects of tight monetary policy on the economy? Okay. Sorry. Yes. Third is correct. It negatively affects, and this is what we know as considered as hawkish policy. Hawkish policy means that you are ready to forego growth just to ensure price stability. This is correct. Both the statements are correct. Factual data you need to know. Biennially they are released, I guess, in July and in January. They come out with the reports in July and in January. Okay, you just check which month they come out with the report. FSDC is chaired by the finance minister. It includes all the heads of the regulators. Which are the financial regulators in India? How many financial regulators are there in India? SEBI, IRDAI, RBI and PFRDA. These are 4 regulators. Okay. And there also RBI has upper hand. RBI is a monetary policy regulator. It has wider powers than these other entities because these have been created very lately. And RBI is since earlier times, and also it used to have certain share patterns in NABARD also, in many of the other AIFIs also. Now they have sold all the shares to the government. Okay. Sorry. Monetization of deficit.
First is correct.
In primary market. Primary market. Monetization of deficit means if the bonds are not subscribed, it remains in the primary market itself. Then it is purchased by the RBI. And once they are fully purchased, then trading happens in secondary market. Then yields and all these things comes into picture.
Only to
It is allowed as per, but only in exceptional circumstances. It may lead to inflation and macroeconomic stability. This is also correct.
Why is first statement wrong, sir?
Which first statement? 1 minute.
Yes, sir. It is the second one. RBI purchases government bonds in second one.
See, monetization of deficit for the first time it happens once the bond is first time issued, then only government collects the money. In the secondary market, any trading, even if it is debt or equity, it is happening between two buyer and sellers. There is nothing to go with the issuer. The issuer is not getting any money. Issuer got money at the first time itself. And once it is not subscribed, the RBI is bound to buy that thing. Getting it? Just like IPO.
No, sir, that is the government, no, sir. Government only, sir.
That is government.
So government only is the person who is buying, no, sir.
No, buying is done by RBI. RBI is buying. Government is saying that, okay, we have fiscal deficit. We have issued these bonds to fund our fiscal deficit. It is open to subscription, and suppose only 50 or 60% is subscribed, 30-40% is remaining, then RBI purchases that bond, but the issue itself is in the primary market. And once it is subscribed, then it is transferred to secondary market for trading, and all those yields and pricing, market prices of the bonds come into picture. Okay. This, it is the amount that bank have to maintain in the form of core capital also. This is correct here.
yes.
This is bound to be correct. Don't talk about this.
उसमें division
tier 1 and tier, in terms of core capital, this is considered to be correct. Is it talking about anything incorrect? No. Only Rata, then it would have been incorrect. If had that been only in form of core capital, this is correct. Only incorrect. CRAR is decided by banks, by RBI, not by banks. CRAR decision, they can have that thing, but decided it is by bank, by RBI, na? They come out with this, the minimum capital requirement. CRAR at 12%, 15%. This is decided by whom? This is, yes, don't, RBI. This is, this is only RBI. What he is saying, if the banks are actually holding over and above, that is up to them. That is not being asked here. That is not being asked. They can reduce it, that is up to them, but they cannot go below it. It is decided by RBI. Okay. I know that what is your confusion. Feel that why would then other person have hired CRAR? It is up to the bank to decide. But what if can they go below it? Then who is deciding it? RBI. So this is it. All the questions. It was a long class, huge.